Good morning, everybody. Welcome, everybody, coming over from pre-market prep. I missed you guys. It's been a long 15 minutes. It's been a long morning. The market is doing some crazy things, but welcome to All Access. This is the show where we take a step away from all that, and today is probably a good day to do that. This week is actually a good week to do that. Market being crazy and all. This is the show where we take a step back and talk to founders, CEOs, executives about their story and about the story of their company. We're not going to get hung up on what the stock is doing in the last 5 minutes. Don't care what the stock is doing in the last 5 minutes. We're not going to get hung up on, minutia. We want to know the story. We have reached out to these companies. We said, hey, come and tell us your story and pitch us. Give us your pitch. Give us your best pitch. So that's what we're doing here on All Access today. We got a lot of companies lined up, ready to roll to have one-on-one conversations with me. So before we get to that, some housekeeping items to address. First things first, you know what to do. It's a Benzinga live stream. You know the only way to make me happy is to hit the like button. It's the one that looks like that, the thumb up. Hit that like button. I'd appreciate that. You see, it says it right there. Don't just hit it. Smash it. Elbow. Fist it with your head. Do whatever you got to do, man. That's the first things first. Second thing, I want to thank the company that helped us make this show today, Redchip Investor Relations, a world leader in research and investor relations in the microcap and small cap space. They were the ones that arranged the companies today, and we thank them very much for their assistance in gathering all of these executives. It was difficult to arrange times and all these different speakers in different time zones from different companies. We couldn't have done it without Redchip. So thank you very much to them. And then the other thing I want to say before I bring on our first guest, as I say every single Friday, is the All Access show is sponsored by Ticker, Tiicker. I'm going to play a quick video that tells you what the heck Ticker even does.
What is Ticker? That's right, Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
There we go. Tiicker/Benzinga. The link should be in the description of this video. If you click on that link, you open your account at Ticker, you connect your broker, and then you confirm your email. When they send you like the confirmation email, you confirm your email, and on that email page, or once you click on that link, there's a little box. It says, are you a Benzinga All Access viewer? You say, yes, you are. And they will send you an Amazon gift card for $20. So there's the steps, ticker.com/Benzinga. Open your account. Get rewards just for owning stocks. That simple. So thanks to them once again. Okay, enough bloviating from me. I'm going to say hi to the chat real fast. What's up, chat? What's up, Juan, Wizard, Justin, Tony, Dylan, Arthur, Renee, Chris, Chase? What's up, Easy Mike, Miss Whitehorse? How we doing? Godid, Chermo. I think I got you all for the most part. All right, let's bring on our first guest. We are talking, we're going to go to REITs first today. We're talking to Medalist, Diversified REIT. We're talking to Tim Messier, he's the CEO, and let's bring Tim on the show right now. Tim, welcome to All Access.
Yeah, this is great.
How are we doing today? You're feeling better?
Feeling better, coming out of it.
Okay.
Not a pretty picture, but I feel a lot better today. Absolutely.
Awesome. All right. Tell us about Medalist REIT and the overall strategy here.
All right, so it's really not rocket science. The Medalist was initiated in 2003 as a private equity firm. Brainchild of my partner Bill Elliott in 2002. I joined as a equal partner in 2003, and we did private deals for years. We bought property by property using friends and family money. We put a formal fund together in 2013 That was Medalist Fund 1. We put another fund together in 2015, Medalist Fund 2. And then we went public in 2018. We went public with $22.4 million through the Maxim Group in New York. Since then, we've done two or three follow-on offerings. We've done a preferred stock offering, and we raised about $55 million. We own 8 properties in the Southeast. We shed one of them last year. It was a hotel, and I'll talk about that in a minute. But Medalist is a different type of REIT in that we are a diversified REIT buying properties in the Southeast with a mandate to purchase limited service hotels, multifamily, flex industrial property, and neighborhood centers. The core of our investment philosophy is workforce necessity real estate. So when we talk about retail, we're talking about neighborhood shopping centers where people have to go to buy things, not just order things online. We also like flex property, which is a hybrid of industrial property.
Right. So let's break that all down for a second. First, why the Southeast region?
Bill and I grew up in the Southeast. We grew up in Richmond, Virginia.
Okay.
Real estate, people you know, and places you know. And we both grew up here. Both went to SEC schools. We know the landscape. We know a lot of players in the Southeast. We're very comfortable in our market area, we good on the ground intelligence with our contacts in the Southeast.
Got it. So, what is the investment criteria here? How do you analyze a property?
Well, we have a 5-year pro forma that we use on each property, and we take the current financials, not what we think or what the seller thinks it will do in the future. Where is it right now? And if we can show on the pro forma that in the first year the property throws out a 9 to 10% cash return on equity invested, then we'll keep looking. And that's the number one criteria that we look at. Also, location, property type, etc.
So, and then how do you source these properties? I mean, how do you find potential properties to buy?
I mean, we've known people in the real estate industry in the Southeast for over 30 years. So we see properties every day, all day long, actually. And we can pick and choose from what we want. The thing that's very vital to our business is equity-like capital. So we can pair that with debt and purchase property.
Getting even more specific here as far as your footprint, Virginia, North Carolina, South Carolina, Georgia, Florida, Alabama. Is there any reason why you focus on those states as opposed to also focusing on Tennessee, Louisiana, Mississippi, Arkansas, Kentucky?
Well, we like to go where we know people. We like to go where we know what the yields are, where we can manage properties pretty easily. And we picked the Southeast again because we grew up here. We know people here. Would we ever expand into the areas? Possibly. Right now, we're in Virginia, North Carolina, South Carolina. We want to be in Georgia and Alabama and Florida as well.
What have the last couple of years been like for you, Tim? I mean, but actually, before we get to that, let's back it up. What was the state of the market heading into COVID? And then we'll talk about how COVID affected it.
Sure. Yeah. I mean, we were doing great. Our properties were all cash flowing. Even the hotels, and But once we got into the pandemic, of course, everyone took a view, and I would say that May, June, July of 2020 were our worst months.
Yeah.
65% of our contractual rents. We went after those people that didn't pay their rent, not on a you know a torturous basis, but we did bear down on them to pay the rent. And by August and September, we were getting 75 to 90% of our contractual rents, and by November of 2020, we were getting 100% of our contractual. So I'd like to say the last 2 years have been unbelievably profitable and incredibly successful. I would say we work very hard.
What is there anything that's driven that? I mean, obviously we've had a dramatic bounce back in terms of the economy, in terms of the stock market, but in terms of the consumer. But are all those macro factors you think of what were behind the turnaround?
Well, in the Southeast, we never ever had the lockdown pandemic that other areas of the country had. Ours was far less severe than California, New York, Chicago, or any of those places. Uh,
Okay.
our property types to snap back very, very quickly. And we were very, obviously, so happy with the results of that. And I contribute that a lot to our management team and the management team of our property manager, Dotson here in Richmond. They did a great job. I think we did in managing the properties, getting our arms around what the issues were, and trying to ferret out what were real issues, what weren't.
Question from our chat here. I'll ask you right now. Do you guys do property lease management?
We don't do that in house. We do that third party on purpose. Uh, when we buy properties in different cities around the Southeast, we try to find a lease manager that is a leasing agent that is working with a large leasing firm, but still from that particular area. So we have in Charlotte, for example, we have leasing agents in Trinity Partners and Cushman Wakefield, and both of those leasing agents are from that area. So it takes them about 10 minutes to get to the property that they're trying to lease for us. Instead of using somebody out of New York, we use a local agent, but a national firm.
Got it. And then can you just speak more about like the flex model? I guess out of the different buckets, out of industrial, retail, multifamily, hospitality, what's the breakdown in terms of your portfolio?
Yeah, all right. So we have a mandate to buy 4 property types, as I just said. We're not looking at hotels right now.
Okay.
Don't know what the business travel is going to end up in 2022. We're very hopeful, but we're not. We don't have a crystal ball on that. We don't. We love multifamily. We've owned a ton of it in the past. However, multifamily's gotten very expensive. Cap rates have gone 3.5% in our area, which is unheard of. So we're steering away from family. So we're fixed on flex industrial and neighborhood shopping centers. Now let me explain flex industrial. Most people, when they think of industrial, they think of big warehouses and large corporations storing their products there. Our industrial is flex industrial, where every unit on a 1-story business community has a loading dock on its back. So that unit can be used as warehouse, all office / warehouse. You have a loading dock, so you have the flexibility of using it either way. And we've done so well with that type of property over the years. We've owned almost 2 million square feet of that over the last 18 years.
So just to clarify, the presence of the loading dock that can change how a property is valued?
Well, it changes the purpose of the property, and it can change how it's valued. Absolutely. The rents in a flex industrial property are usually right between just all industrial and lower grade office, and the aspect.
So is that the space you're most bullish on right now?
We are bullish on industrial, and we're bullish on neighborhood retail, necessity work retail.
Can you explain what that means? Are we talking like grocery stores here?
At grocery stores, in the shopping centers, we have hardware stores, we have Hobby Lobby, in some we have hairdressers, we've got the cleaners, we've got restaurants where people have to go. We create foot traffic in those shopping centers.
So what kind of properties would you avoid? Like, I guess what is unnecessary retail?
Uh, for us, that's necessity for some people, but not for us.
Right.
Large malls is not for
Okay.
us. It's not strip center, but it's not large mall.
Okay.
They're very attractive necessity shopping centers.
Got it. Can you walk us through the portfolio a little bit in terms of the specific properties and why?
Yeah, sure. We own 4 shopping centers that are scattered around in Virginia, North Carolina, and South Carolina. I would say that 2 of those are 100% occupied. One is 94% occupied, and another one is 83% occupied. Let's just stick with the retail for the second. All retail properties, even the one that's at 83% occupancy, they're cash flowing really well. They're producing tons of cash flow. And I can't talk about numbers right now because we're in a blackout period where we have to file our 10K here in about a month. But suffice to say, our shopping centers are cash flowing well, and we have tenants looking at whatever vacancy we have, and once that vacancy fills up, we will have created more value in those shopping centers than we've already created. So 2 are 100% occupied, one is 94% occupied, the other one is 83% occupied. Now, as we move down the chain, we're going to look at these flex properties. We have 3 of those. Brookfield Center is located in Greenville, South Carolina. It is 100% occupied. It's got a diverse tenancy. One of the largest tenants in there is Gravitopia, which is the largest producer or creator of sorry, I'm drawing a blank, of trampoline parks in the world, actually, in the world.
Wow.
Locations all over the world, internationally, and we're happy that we have their headquarters in our space in Greenville, South Carolina. So 100% occupied there. We have another flex property in Chesapeake, Virginia, that is 90% occupied. It's called the Greenbrier Business Park. Again, we have tenant prospects for the rest of that vacancy. Again, we will create value in that property over and above what we've already created. And then we have the Parkway property, which is a fairly large flex property in Virginia Beach, Virginia, and that's 100% occupied. We also have the Clemson Hotel, the Best Western Hotel in Clemson, which is about I would say a little less than a mile from the Clemson University campus. Clemson has leased that property through May 5th. We're not sure what they're going to do after May 5th, but we're trying to negotiate an extended lease with them. They leased it for their COVID students, and we also have it out for sale to some prospects that would like to buy it to turn it into a student housing program.
So, Tim, obviously the goal is to, have all the properties 100% full. But at what point for you, like, at what point is a property dangerously low in terms of occupation?
Dangerously low as far as occupancy. I would say you're starting to get dangerous around 65 to 67 percent occupancy.
And all yours well above that right now. Tim, is there anything else like you want people to know just about the space and real estate in general right now?
Sure. Look, I watch what's going on in the rest of the country, but I watch every day what goes on in the Southeast. We know our market. We know the players in our market. We know that yields are higher in the Southeast than they are anywhere else in the country. On flex and neighborhood shopping centers, we're still seeing 7 to 8% cap rates. That translates into a 9 to 10% cash flow on equity invested right out of the gate. We're seeing very attractive properties in the Southeast. We have good on the ground intelligence. We are in touch with the market every day, and we feel like we have our hand on the pulse of what's going on in our market area, and we're proving that on a daily basis.
And then just last one here, Tim. Can you just speak a little bit about how, like, how that market or how your properties or how the business would behave in an inflationary environment?
Yeah, I will. I personally don't think there's going to be a huge amount of inflation. There might be a little bit that's real over time. However, we have locked in on those 8 properties very, very low interest rates. And some are sub 3%. And with mild inflation in our market area, we should be fine. As long as prices don't go up 200 or 300%. People will still go out and buy things at the properties where that we operate.
Awesome. And if there's any I forgot to mention this before. If there's any questions for Tim or any of our guests today, please don't hesitate. Put them in the chat. We do this as much. I mean, we do this for you. We don't do this for our health, right? We're not having these conversations for our health as much as that would be interesting. Tim Messier, CEO, Medalist, Diversified REIT, ticker MDRR up on the screen. Tim, I know you were feeling a little bit under the weather, but I appreciate you powering through to join us today on All Access. Thanks for coming on.
And another 15 seconds. I just want to say we have a great management team that's worked hard over the years. That's worked together over the years. We know what we're doing. We would love to have you as an investor. Please take a look at us. DRR. Our stock is very, very undervalued. I'd like to have you take a look.
All right, wait, there's one question from the chat. I'm sorry, I missed this one earlier. It's from Buglog. Are you planning on doing a reverse split in the future?
We are not. We have no plans for that.
Okay, there we go, Buglog. Thanks a lot, Tim.
Hey, thanks so much for having me on your show.
All right. Something I forgot to mention earlier that I want to mention again, or I want to mention it for the first time. I say this again every single week, is that this show, this All Access show, is one of the ways that Benzinga monetizes its YouTube channel and it's what we call our show's effort. Okay, so the companies today have partnered with Benzinga. They've paid Benzinga to be here. However, big however, they do not know what I'm going to ask them. And even better than that, they do not know what you are going to ask them. There are very few questions. Basically, like, the only questions that are off limits are like personal attacks are off limits, right? That's big. But if whatever you ask, I will do my best, if we have the time, to ask it, as I'll relay your question from you in the chat to the guests. So I just want to throw that out there. But we are upfront about the fact that this is one of the ways that we monetize our channel. Let's move on to our next guest here, and I want to bring him on. Edmundo Gonzalez is the co-founder and the CEO of Marpai. We're going to go from real estate to insurance. That's a natural segue. Sure, why not? Edmundo, welcome to the show.
Thank you. It's a pleasure to be here with you. How are you?
Doing fantastic. It's Friday. Thank gosh, we made it. So let's just start at a high level. A lot of people may have heard of Marpai. Tell us about it.
Yeah, so Marpai is a technology company, actually,
Right.
first and foremost. We operate in the healthcare space, and what we do is provide all of the healthcare benefit services for companies that have chosen to be self-insured. You know, if you're a company of, say, 300 employees, you have a choice. You can either buy health insurance for your employees from, say, Blue Cross or United or Aetna, or you can be self-insured, meaning that you're paying for your medical costs as you go. So we help that segment of the market pay all of their claims, but we also do something that's maybe a little bit different than everyone else. We're able to predict health outcomes, and this is what's really exciting about Marpai. We can tell who in a population is on a journey to be sick, for example, or who's on a journey to have a high cost surgery, and then we can help that member through that journey.
How you do that?
Well, it's actually through a mountain of AI. So we entered this space actually with a very simple goal. I wanted to predict costly events in healthcare. I thought if you could predict who's going to end up in the ER or who's going to have a high cost surgery, you could build an entire company around that. So that's what we did. We have an amazing research library with hundreds and hundreds of millions of claims, medical claims, and other data. We have some of the best people in a discipline called deep learning. This is one of the facets of artificial intelligence. So our algorithms actually are looking at patterns in our research library and then matching that to a member of our plan as he or she goes and gets, say, that fifth or sixth prescription from CVS.
Mm-hmm.
That's how we do it.
So I mentioned you were a co-founder. I always want to know whenever I talk to founders is like what happened in your life or in your personal life or in your career that made you like stop what you were doing and be like, yeah, this is a good idea. I'm going to do this.
Yeah, for me, maybe it was slightly a more traditional path than some co-founders or founders. I've been doing this for about 20 years. This meaning starting companies, raising money. I've also been on the other side as a venture capitalist, funding these types of companies. And this particular one came about because we had been actually investing in my co-founder now, Dr. Eli David. He's one of the foremost thinkers in artificial intelligence, specifically in the world of deep learning. So had a lot of success with him, and we wanted to do something in the healthcare space that would really impact lives while creating a wonderful business. So we teamed up with Eli as our co-founder, and made it work.
But how did you know that it would be a viable business? Because when people think, oh yes, health insurance, their first thought is not great business to be in. Maybe I mean it's a bit of a mess.
Well, it's a great question, Spencer. So when we started, the mission first and foremost was let's predict costly events. So let's see who's going to be sick. Let's see who's going to end up in the hospital, because these very very high cost claimants are what drives most of healthcare, a lot of healthcare expense. So we had no intention of becoming a healthcare insurer, a payer, as we call them in the industry. Now, my intention, once, lo and behold, we had all these models and we could predict who was going to be sick in a population. So I went around and talked to all the big CEOs of the classic, healthcare payers, right? Healthcare insurers. And they're saying, wow, this is great. This is amazing. You can actually do this. And I'm like, yeah, this is your data, which you shared with us, on a confidential basis and a secure basis. This is your data. And the thought in looking at them across the table was like their mind was spinning, but then they would pause and say, okay, great. So what do you want from me? Which is kind of an extraordinary thing to say. If you're a senior healthcare executive, I'm giving you a list of who's going to be sick and you're asking, so what do you want from me? So because of my background in venture capital and private equity, we did something very unusual, which is I bought my client. I said, look, these guys, they're never going to get it. It's just, they're stuck on paying medical claims. That's their business. So let's create something new in the world, something that is a healthcare insurer, a payer, but a payer of the future, one that is really efficient in doing the normal business of healthcare insurance, but one that can also look at costly events and better help the population that it serves be healthier, because that's the only way you're going to get lower healthcare costs. So it was really that aha moment when my potential customers were like, "Oh, this is awesome, but what do you want from us?" I said, "You know what? Let me do it." That's
So,
how I became a payer.
so like hypothetically, you look at someone, who's in their mid-20s. Oh, this person is an asthmatic, and therefore they are 30% more likely to develop, I don't know, lung condition X down the road. Is that more a simplified version of how it works? Or
Not not so much,
okay,
because what we're doing really is looking at entire journeys. So in our research world, which represents society, right? We have millions and millions of lives, all kinds of people. It's a very diverse set. So our algos are learning what's happening in that research world. Now, let's say as I go to the doctor for the third time for a certain condition, that journey, along with the fact that I'm male, late 40s, and Latino, and live in this zip code, and along with all of my medical journey, that is compared to our research world. And in many cases, in most cases, actually, the result is nothing. Meaning there's okay, you're just consuming healthcare, but there's nothing unusual to report. In many cases, our algos come back and say, wait a second, Edmundo's journey looks like these other 10,000 patients in our research world that actually ended up in the ER in 6 months. So let's get Edmundo to proactive care. Let's get him to get some labs, get to his primary care physician or internist. That's what saves lives. That's what improves lives.
it's so interesting because I've long grappled with the idea of health insurance, because health is something that you it's an ongoing thing, right? And the idea that you would, like, in the same way that like auto insurance doesn't cover like your gas or like an oil change, right? It covers like, an accident, but like medicine, and so the model is the same as car insurance, but health insurance is very, very different. There are very different consequences. I've just grappled with that. I've had a hard time grappling with that in my head. So this is sort of turning that on its head in being predictive, which I think is interesting. Can you just explain, like, if we think about like the health insurance universe, where exactly does Marpai like fit? Like, you're between the payers and who, or you're not?
Yeah,
Yeah,
I'll definitely. So first and foremost, we are focused on employers, right?
right.
Companies, and also local government agencies like school districts that first and foremost have chosen not to buy health
Okay,
insurance. So they
right.
said, you know what, we're going to be self-insured. We're just going to pay the medical claims for our employees as they come. So that's a very big distinction, because when you say insurance, we're talking about United Healthcare, Blue Cross Blue Shield. Those are all very good products. That market is dominated by 4 big players. We're on the other side of the fence. And my side is 1/3 of all healthcare spend. It's $1 trillion, trillion with a T. So it's huge, but it's served by 200 players out there in the country. Very, very fragmented. So first and foremost, that's my segment, right? That's my competition is other people, other companies that service the self-insured. Now, we're a type of payer. The only thing is we don't take risk, meaning our clients, let's say a company of 300 employees, they're the ones actually paying for those medical bills. The only thing is they don't know how, right? Medical claims, it's not like just paying your telephone bill. This is a very highly technical, highly complex area.
Yeah.
So that's where we come in. We make sense of all of those things, and we try to save them money. And what my thesis is, the only way to save real money is to get that population healthier.
So you mentioned the fact that your space is so fragmented. When we look at the other players in there, and we're talking about names like Marpai and Oscar, right? And Centivo. So how do you differentiate?
Basically, it's in our ability to predict health events, to predict who's going to be sick, who's going to end up in the hospital potentially, and also who's going to have a high cost surgery. See, all of these new players, a lot of them are funded by Silicon Valley VCs, and they're great. They're creating great products, but they're focused on creating a super efficient healthcare payer, meaning one that is using a lot of technology and everything. That's all great. We're doing the same.
Mhm.
Our big differentiator is that I get kind of outside of Marpai and look at the populations we're serving to get them healthier. Look, we're a tremendous system here, best in the world, but we're a sick care system, not a healthcare system. If someone's sick, of course we take care of them. We're very good at that. We're just not really good at preventative medicine in this country. That's what we're changing.
Yeah, I think that's a better way of putting what I was trying to say before. Sick care versus healthcare. We do sick care. We do reactive care. We don't do the proactive stuff. So, yeah, this is obviously needed. I'm just curious as far as your clients and the type of businesses that you sign up. Is there a specific it's anyone that opts to pay their health insurance, but is it like a specific size of business or anyone really?
Look, traditionally, the self-insured space was dominated by larger players. Why? Because if you have 10,000 employees, you essentially have an insurance pool, right? You're diverse. Now, we've seen in the last years that the average size of client and the market here is growing because smaller groups, let's say you have 100 or even 75 employees,
Mhm.
you're moving away from the traditional health insurance, fully funded insurance, to self-insurance, just because that side of the house is only going up, and up. There is no way down. So that is really what's driving growth in our space. It's those smaller employer groups coming into the self-insured world.
I had a hunch you were going to say that, but I wasn't sure. And then as far as like the actual products that we're talking about, I mean, you have your deep learning and your AI technology that is delivering these insights, but like how is it delivered? Do you have multiple product types, or like what is the delivery mechanism here?
We do. So first and foremost, as my COO, one of the kind of senior people in the industry and self-insured, she
Yeah.
always reminds me, first you got to pay claims, right? So before the AI and everything, we have to be really good at paying claims.
Yeah.
So it all starts there, and that's our core product. Now, the interesting thing is that represents now only a third of our revenue. That's the blocking and tackling, meaning analyzing claims, checking for errors, making sure everything is good, and then paying those claims. That's the bread and butter. The other pieces are all of our prediction tools, our intervention as well. Think about it. If I have an alert driven by an AI, right, that says Edmundo is on a journey to be sick. Well, okay, but so what, right? What do you do with it? You have to close the loop. That is really the secret sauce here. So the consumers of all of these alerts or predictions is a care management group, meaning clinicians that actually reach out to my members and get them to the right care. These products always work together. We never sell prediction without this clinical approach. That's where the magic really happens.
Got it. Got it. And then I'm just wondering, something I always try to ask is, and I asked our last guest this as well, is like secular tailwinds or headwinds. Like what is working in your favor right now, and what's not working in your favor right now?
Look, the biggest thing here is that the cost of overall healthcare is still going up. I see no reason to believe that all of a sudden magically it's going to go down. Even in an inflationary world, one would expect
Right.
these prices to go up. So my clients, again, who are companies across the country, as well as local government agencies like school districts and towns, they're under pressure. They want to provide great health care to their teachers, to their employees, to their firefighters, et cetera. They just can't afford it anymore. So that's where we come in. We can save plans if you're moving from fully funded, let's say a traditional health insurance model, to self-insured. We can save them, up to 40%. It doesn't start there. It could be 15% in the first year. But this is really the what's driving it is the overall cost. It's just only known one trajectory, and that's up, up, and up.
This is a fantastic question from our chat. God, I love our chat so much. Sadat, this is probably the $1 million question, and I'll bring it up on the screen. How do you standardize the algos to discount economic background, as this is the biggest determinant of poor health? So people from poor areas will pay more. Great question, Sadat.
It is a great question. So first and foremost, we have to consider all of the social determinants of health in any prediction. Your zip code, your access to healthy food, your access to transportation, these are key metrics that matter in one's health. So what we've done is actually incorporated this in our predictions and our understanding of these members. In many cases, this is just not done, right? The first thing you need to do is to recognize the fact that this is a problem, that there is inequality in access to healthcare, and then do something about it. That's exactly what we're doing. This is part and parcel of our intervention.
Yeah, okay. That was a good answer to a very tough question, but it's worth pointing that out for sure, right? You want to avoid any inherent biases or anything that may cause, any bias in the data, and typically poor people do have poor health for a reason. So great question, Sadat. Thank you for that. Just to wrap it up here, Edmundo, is there any final thoughts? Anything we haven't covered that yet? Not necessarily about Marpai, but even just about the industry that we haven't gotten to yet.
No, look, it's a growing space. We're building something new in the world. I'm really, this is not my first kind of journey in either healthcare IT or building a technology company. It's very rare that you can build something that impacts people's lives for the better while creating a great business. And that's exactly what we're doing. So we just went public in October of last year,
right?
And we are hard at work to build a really substantial player in this space.
Awesome. And Edmundo Gonzalez is the co-founder and the CEO of Marpai. Ticker MRAI up on the screen. And Edmundo, it's been a pleasure to chat today, and looking forward to follow the progress of Marpai. Thanks a lot for coming on All Access.
Thank you, Spencer. Thanks so much.
All right. Hey, go ahead and Ahmed. Ahmed's asking, what am I watching? Ahmed, I don't know, man. What are you watching? Well, what are any of us watching right now? No, you're watching Benzinga All Access, man. Come on. It's our weekly show where we connect you to executives, CEOs, founders, COOs, operators, right? And they tell us the story of their company. They tell us the story of their company. We spend every day on this channel talking about stocks and the intraday movements and short-term price action. But please, if this market has taught you anything, please have a long time horizon. One of the ways to develop that time horizon is to put away the chart for a second. Learn about the company, learn about the story, learn about the people behind the company, learn about their story. That's how you have a long-term. That's how you don't get freaked out when your stock drops 10% on you. If you have a long horizon, if you know the story and you're confident in the story, okay, this is one of the ways we do that. So this is one of the ways we encourage everyone that's watching, or all of our viewers or listeners, whatever, to have that longer term time horizon and look look at more than just the chart, and yeah, look at more than just numbers. Numbers are important, but they're not everything. They really aren't. How does the business work? That's the point of this. How does the business work? Please ask questions if you haven't. Let's bring on our next guest here. Curtis Schloffman is the head of comms at DeFi Technologies. We're going to pivot from healthcare tech to decentralized finance because that's what we do here. So let's bring Curtis on the show right now. There he is. Curtis, welcome to All Access.
Hey, Spencer. Good to be here.
Great to have you. Great to have you. All right, DeFi Technologies. Oh, wait. I forgot. I had a video. I want to play the video. Yeah. I want to play the video, and then we'll talk. So let's do that right now.
Cool.
Traditional financial transactions are controlled by middlemen. Decentralized finance frees the system from these institutions' constraints. With drastically lowered costs, decentralized finance has great investment potential, and its total value has grown from $500 million to over $50 billion in just over a year. But it's complex and crowded, lots of protocols, approaches, and players. Without expertise, an investor could wind up with heavy losses. To help, DeFi Technologies brought together thought leaders in finance, technology, education, and cryptocurrency to educate investors on decentralized finance and create easy, understandable ways to invest. With 3 unique products for individuals, institutions, and innovative DeFi projects, DeFi Asset Management and DeFi Venture tap into our expertise by identifying and investing in widely used revolutionary DeFi protocols and early-stage projects we believe will be world-leading DeFi names, empowering everyday investors to take concentrated positions without a crypto account. Running independent nodes that validate transactions, DeFi governance earns a share of each transaction within widely used DeFi protocols. Get direct access to the next financial revolution at defi.tech.
All right, now, Curtis Schloffman, welcome to the show. Tell us about that video. Sort of explained it, but tell us like how this business works.
Yeah, so we've evolved a bit over the past year. We are a SPAC, so we're still in startup phase. Let's start with the beginning with our co-founders.
Yeah.
One of our co-founders, Ali Rusi Newton, was also the founder of Hive Blockchain Technologies, and they were one of the first Ethereum and Bitcoin miners that went public. So they're in the TSX in Canada. They just got uplisted to NASDAQ a few months ago here in the US. And Ali got together with Johan Wattenstrom, who is one of the founders of XBT Provider, which is now CoinShares. If you're familiar with the crypto space at all or the asset management space, CoinShares is a $5 billion company. And they really wanted to figure out a way how they can leverage this decentralized finance movement just outside of Bitcoin and Ethereum and give investors direct access to the fastest growing space in the history of the world from a technological perspective, 2 times faster than the internet to this point. So they came up with DeFi Technologies, and our primary business line are investment products. So exchange traded products that give public market investors access to decentralized technologies and Web 3.0 protocols. So you can go and buy Bitcoin, or you can go buy an Ethereum, Solana, Polkadot on a public market exchange. So right now that's only available in Europe. We started on the Nordic growth market. We just listed our products in Germany and then throughout the rest of Europe via the Euronext exchange. So that's our primary. So asset management and products is our primary vehicle there.
Here's why I like a business like this is because look, some of us, we forget when we go into our holes, we go down these rabbit holes on the internet. We forget that the vast majority of people do not know what we know, right? Frankly, opening up a Coinbase account for a lot of people is just simply too much. It's a hurdle, right? And not everyone has the know-how or even the desire to do that. So there is an entire, fortunately, we have an ecosystem in place already, but there is this disconnect, right? There between DeFi, crypto, and that traditional space. And companies like yours are trying to bridge that disconnect and make that new space available to the people that, again, that don't or can't, or for whatever reason, don't have access to it. So I want to bring up this chart here. Can you just explain just the business? I see a few questions in the chat. I'll get to you. Don't worry, I'm not ignoring you. But can you just break down the business for us? The video sort of did a little bit, but can you just go more about that?
Sure. And to be fair to your point, there are things that we don't know that other people know. So it's important to have experts and people who are knowledgeable and seasoned in particular industries to help guide the way. So what I just talked about was our DeFi asset management. We do this through our wholly owned subsidiary Valor. We went from zero to nearly $400 million in assets under management in just about 10 months. Near in the market high, which was at the end of October. We've had a few months of downtrends in crypto, and to your point earlier about having a long scope and play the long game when it comes to investing, that particularly applies to cryptocurrency or any new asset space where volatility is super high at the very beginning. I mean, if you look at the early stages of the internet, you're going to see that too. But under our next business line, we have DeFi infrastructure. So we also support decentralized finance and its ecosystem by running independent nodes for particular projects. Right now, we have a Solana node that's supported by Bison Trails, which is owned by Coinbase, and that's an infrastructure project there that we're leveraging to earn additional revenue via that stream. So the way governance works, we call it infrastructure, so that way it's more easily to digest. People understand that better. Most or all of decentralized finance are free of intermediaries. So like a board of directors, governance brings together independent validators, and we're one of the independent validators on the Solana network. And every time a transaction is processed, we earn a share, pretty much a share of that revenue, or a portion of tokens for that particular blockchain ecosystem.
Right.
We also have a venture capital arm where we will invest directly in up and coming decentralized technologies or Web 3.0 technologies. Most recently, we did a block token purchase with Wilder World, which is an up and coming metaverse and gaming ecosystem. They're the third largest in the metaverse ecosystem right now at the moment. So wherever we see potential in the market with particular up and coming companies, we take an interest in them and invest directly in them as well.
All right. Edmund D asked, what is your current or recent AUM? Edmund D, boom.
Boom.
There you go.
Yeah. So there it is. A record high of almost 400 million there.
This is
this
is as of October, right?
October 27th. Yeah. We'll have a more recent announcement once we come out with our Q4 earnings, which should be at the end of March sometime. But the more important thing here is that we do have an increase of daily flow with our products through the Nordic Growth Market, Euronext, and the Frankfurt Exchange in Germany. The products we currently offer are Bitcoin Zero and Ethereum Zero, which we charge no management fees for, and I'll get to why in a second. Yeah. And then we have a Cardano exchange traded product, Polkadot, Solana, and Uniswap. Those we do have management fees, which we earn revenue off of 1.9%, which is still one of the lowest fees in the sector. But the reason we're able to charge really low fees or no management fees for Bitcoin and Ethereum is because we're also able to stake and lend our products. And at the moment, we're the only company in the world that's able to do that with their exchange traded products. It's a great revenue stream for us, especially as we add to our AUM. We can take increased positions in our staking and lending, which would exponentially maximize the revenue that we're getting in for the business and obviously for our shareholders to increase our valuation.
And can you just be absolutely clear again as far as where your products are listed and where they're not listed?
Yeah, so DeFi Technologies, right now you can buy, it's a listed equity on the NEO Exchange and the OTC markets in the US. In the US, we are approved for NASDAQ uplisting. We're just waiting on SEC approval. SEC takes their time, apparently, with cryptocurrency companies. Usually they've passed on. Once a company typically gets NASDAQ approval, it's right away. So we're still waiting on the SEC from that front. But through our subsidiary Valor, who creates our products, they are listed and available to folks who have access to the Nordic growth market, the Euronext exchange, and then also the Frankfurt exchange in Germany. So U.S. investors aren't necessarily able to buy our products, but anyone outside of the U.S. who has access to those exchanges are able to purchase those. However, our investors who purchase our equity in the U.S. have exposure to the underlying and all of our assets under management.
And again, OTC markets, there's a ticker on the screen, DEFTF. Are there I'm not going to ask you if you're like going to uplist. I assume it's in the plans one day, but are there challenges, I guess, like in the same way that like the grayscale funds are on the OTC for a reason? Are there challenges to being on an exchange in the US that are unique to your business?
Well, with OTC in particular, there's less access to liquidity. Once we get onto the NASDAQ, we'll be able to,
Right.
like more people will be able to buy our
Right,
stock.
but I guess like is there a regulatory reason why you're not there now is what I'm asking. Just like with the ways with other companies in your space.
Oh, in terms of the products?
Well, in terms of just your own equity, right? I mean,
Oh no, I mean in terms of NASDAQ or
yeah.
not that I know of.
Okay,
Like we get
Okay.
we get questions from the SEC. We
Okay.
answer them, and then we're waiting on it. So
Yeah, and Easy Mike in the chat is pointing out that yesterday the SEC swatted down yet another Bitcoin ETF application from Fidelity. I want to bring this chart up on the screen. This has got some of your upcoming products that you've announced. These are interesting. Again, I'm assuming the same idea, right? Not available in the US yet. But tell us about these and what's the logic behind. I mean, I understand, going for different coins and all that, but a metaverse and gaming, exchange traded product, while very interesting, I guess what is the logic behind that?
So metaverse and gaming, that's driving a lot of interest and a lot of investment into decentralized finance itself. So it's a booming industry. If you look at NFTs, that's been the biggest sort of trend over the past year, where nobody knows what they are or what their significant value is. But Web 3.0 is the future of the internet. The metaverse is going to be a big part of that. I think it's pretty clear that every day the world becomes more and more digital, and the metaverse is going to be a primary sort of central mover and driver of digitization of the internet and pretty much our everyday lives. So we're taking a look at some of the top 5 metaverse and gaming protocols, and that would be included in our product. So it'd be a basket product, so you get diverse exposure to it to limit risk. The same would apply for our top 10 DeFi, and then I believe our top 5 or top 10 digital assets, and then top 5 DeFi assets.
Got it.
Well. So we're creating basket products, so that way you get holistic exposure with one product.
All right, there is a long question. I'm going to try to find it. Actually, before I get to that one, we had a shorter question just about the SEBA deal. I want to bring up. Can you just talk us through that and the implications and what that means?
Yeah. So SEBA Bank AG is, in simple terms, it's a crypto bank. They're a digital asset bank, and we recently announced a preferred partnership with them. They have $1 billion+ in assets under management and are in 25+ different markets. And we're going to be participating with them on product launches, staking, direct investments into up and coming protocols, and moving into the markets they're in to offer our products potentially as well. We're still in discussions on what the partnership and how our collaboration will continue and move forward. But for us, this was a game changer for our company, for any publicly traded company that is involved with assets, to have a bank to help and to use and leverage with your product lines or your business model is a huge deal, especially with a bank like SEBA, where they have one of two FINMA licenses in Europe, which means they're regulated and able to trade digital assets in all of Europe and anywhere they're in their 25 plus markets across the world as well.
All right, we got a couple minutes here. Let's do some questions from the chat. From Edmund D. When do you expect real trades on the Euronext valid products rather than just validation trades?
We've had some trades this morning with Euronext. Let me start by, we launched in Nordic Growth Market, I believe last February, and it was slow to pick up. It takes a few months to actually get some traction within those markets. We are setting up a robust marketing campaign and then setting up a sales team within the European market. So you should see additional movement over the course of the next few months in terms of trading volume as we get sort of boots on the ground, so to speak, and start ramping up our efforts across all of Europe to move our AUM.
Tony from Toledo wants your best guess as far as when your products will be available in the U.S. And he says he owns the stock.
Well, I haven't had a conversation with Gary Gensler, so my guess is as good as anybody's.
That's the key, isn't it? And again, I mentioned the Bitcoin ETF rejection for a reason, because the SEC is nothing if not consistent in their consistency. It's been an uphill battle, but I think we're getting somewhere slowly, but we are getting somewhere.
Yeah, and like to that point, like the world is so big. We're working on Europe right now. Canada is probably going to be prior to the US. The US is just so slow when it comes to this space. I don't get it. They're kind of shooting themselves in the foot. So,
but the idea here is like the products aren't available here, but the whole idea is like the DeFi Technologies as a company, again, trades OTC in the US. You can buy their security in the US, get the exposure that way if you want. You don't necessarily have to, create an account on the, in Europe somewhere and deal with the challenges of that. And then just as far as like upcoming catalysts, Curtis, like what's in the pipeline? What's the next like big driver here?
Yeah, I mean, we're going to continue to grow and list across as many markets as we can. That'll enable us. The big things right now is we're really focused on product launches. On the slide previously, we have 6 upcoming product launches. We're going to continue to list additional products on our current exchanges, and then I think the big thing as well is let's see where our collaboration with SEBA goes, because I think that's probably going to be the most significant mover of value for our company.
Awesome. Curtis Schloffman is the head of comms at Diversified Technologies. Curtis, thanks for waking up super early to hang out with me, hang out with us for a few minutes. I appreciate it. We will be following your progress, especially as the SEC shuffles its feet forward, or even if we could just get other developments in other countries. It's probably probably our best bet right now.
Yeah, well, appreciate the time. And if anybody has any questions, feel free to email us, ir@defi.tech. We try to be as transparent and communicative as possible. So.
All right. Thanks a lot. Guys. The DeFi crypto blockchain space is so emerging. It is so early. It is so exciting. My head is spinning, frankly. Whenever I have a conversation with someone like Curtis or a company like DeFi, my head spins because, it's not quite the same thing, but it really does feel like in a lot of ways, it feels like 1997, right? 98 in the internet. And we can't even really grasp all the implications of this technology yet, which is super fun stuff. Hey, how are we doing on likes? It's been an hour since I've groveled. You guys know I love to grovel for my likes. Where are we at on the like front? We're at 117. Oh, let's get to 150. Let's get to 150. I think we can do it. We're going up right now. Let's bring on our next guest. In the meantime, I've got Greg Duncan is backstage. Greg Duncan is the chairman and CEO of Virios Therapeutics. And let's get Greg on the show. Greg, what's up, man? How we doing?
Good morning, Spencer. How are you today?
Doing fantastic. It's Friday, which is always a good day. I have some slides from you that I'll share in a second. But before I get to that, tell us about Virios, but more importantly, tell us why you're working on what you're working on.
Sure. So simply put, Virios is a clinical stage biotech company founded on the principle that there are very common viruses, herpes simplex 1, Epstein-Barr viruses you've heard of, that infect the vast majority of adults across the planet. And when those viruses get activated, can actually serve as a catalyst to chronic waxing and waning long-term diseases where the symptoms are very significant, unbearable at times. They get a little bit better, they get worse, they get better. They tend to wax and wane over time. And the founder, Dr. William Pridgeon, had a very interesting thesis. And his belief was that if you could get these activated viruses back into a dormant state, you could deliver significant, maybe more durable outcomes for patients by treating them with antiviral therapies. And as a consequence, the company really has progressed into developing combination antiviral therapies to treat patients with diseases that you may well know: fibromyalgia, irritable bowel syndrome, chronic fatigue syndrome. And I'm very excited to tell you to date, Spencer, the thesis has been endorsed, if you will, through both mechanistic data in animal models and human tissue models. And we've already got a very significant positive proof of concept trial, a phase 2 trial, which shows the benefits of our lead compound, IMC1, in delivering very significant benefit for patients with fibromyalgia. So our goal now is to progress a phase 2B program, which is fully funded, to continue to validate that thesis with the goal of harvesting data this September. And ultimately, what we hope to do is to gain FDA endorsement to progress to phase 3 to change the lives of literally millions of patients around the globe. It may surprise you to know that there's something north of 100 million people across the globe that are suffering from fibromyalgia. There's more than that who suffer from irritable bowel syndrome, and a tremendous number of patients who suffer from chronic fatigue-related disorders. So we're really excited about the potential for this particular therapeutic approach to change the lives of many, many millions of patients.
So we've got oral IMC1, right? That's the one that's the drug that's in the phase 2A.
So IMC1 has been tested in phase 2A.
Okay.
We saw terrific pain reduction in fatigue, reduction in things like depression and anxiety, and overall improvement in patient outcomes. We have now progressed IMC1 into phase 2B. The phase 2B has really been designed, frankly, Spencer, as a phase 3. It's the duration, it's the endpoint, it's the inclusion-exclusion criteria that FDA used to evaluate new therapies. And we're really excited about the potential results, which will be harvested this September.
And is this the pipeline right here?
So effectively, we have intellectual property protection, 21 patents on a whole host of combination antiviral therapies.
Okay.
IMC1 is the most advanced therapeutic within our pipeline. We will be doing a pipeline update sometime this quarter to discuss whether or not we move IMC1 into a second large indication, something like irritable bowel syndrome, or we move a second product forward into one of the disorders that is a target for this particular therapy. Specifically, we're evaluating IMC2, which is a combination of valsiclovir and celecoxib, into a fatigue-related trial. But ultimately, we'll update the investment community sometime this quarter with our decisions about what would be the next research opportunity for Virios Therapeutics.
So I've got this table up here about the slide about fibromyalgia. I guess I didn't realize how widespread of a disease it was.
Yeah, so it's very common, Spencer, for me to ask folks like yourself, do you know somebody with fibromyalgia? And some people say yes, some people say no. But when we go through the background to the disease, people often say, wait a minute, I think I do know somebody with fibromyalgia. And this is a chronic disease. The hallmark symptoms are pain and fatigue. And when the pain and fatigue persists for 3 or more months and we rule out other causes of the pain, we land on a diagnosis of fibromyalgia. This is a disease that impacts between 2 and upwards of 8% of the US population. These patients are in tremendous pain. They actually have 3 times greater risk of committing suicide versus the general population. They are prodigious consumers of healthcare resources. It may shock you to know that people who have this disease, in many cases, in fact, upwards of 50% of these patients, miss work when they get a disease flare-up. And that's a bad fact, made worse by the fact that one of the leading therapies for these patients to control their pain is actually opioid therapy. We all now know the downsides of chronic opioid therapy, and our research suggests that somewhere between 10 and maybe upwards of 40% of patients are treated with opioids to control their pain. So our thesis here is that if we can address what we believe is a viral mediation for this particular disease, deliver pain results, reduce fatigue, improve patient functionality, and get patients off these ineffective, and in some cases addictive therapies, we have a real game changer for patients with this particular diagnosis.
And can you just go into as much detail as you can about the timeline here? You said you're going to provide an update sometime this quarter. That would be on the phase 2B trial. Let's make a couple of assumptions here, Greg, and let's just skip ahead past that step. What's next, and what's the timeline?
So suffice it to say that we're presently enrolling the phase 2B study, which you referenced, Spencer.
Yep.
We have something north of 300 patients, somewhere between 310, 315 patients enrolled to date. The target is to get a little bit north of 400. We expect to complete enrollment for the phase 2B program by the end of this month. And basically, we give people a little bit of a grace period, but we would hope to have all 400 plus patients in the trial by the first week in April.
Okay.
If we carry on with the fibromyalgia timeline, effectively what we would have is last patient, last visit, sometime in the early summer. We'll clean and scrub the data, harvest the data in September. That will be our big data reveal. And then the plan would be to get down to the Food and Drug Administration sometime in Q4 to scope out exactly what the phase 3 program looks like. The good news is that we're funded through basically Q2 of 2023. That gives us 6 to 9 months worth of runway to get down to FDA, scope out exactly what phase 3 looks like, and decide, do we want to go alone and raise additional capital to run the phase 3 program? Or do we want to partner the asset? Both are very viable options. I would say the idea of going alone, many biotech companies talk about, but in fact, we have a team between myself, the board of directors, and our exquisite executive team that actually has developed and launched 2 of the 3 approved drugs by FDA to date. So this is a space we know well. Myself, Rick Birch, have had direct responsibility for Lyrica during our tenures at Pfizer. In fact, Rick launched Lyrica for the treatment of fibromyalgia during his tenure at Pfizer. And Mike General was the chief medical officer and co-founder of Cypress Biosciences, and effectively his team developed and launched Savella. Lyrica, Savella, and Cymbalta are the only 3 drugs ever approved to treat this particular condition. So the other thing I would mention is Mike actually served, our chief medical officer, served as a consultant to the Food and Drug Administration before any of those 3 drugs were approved. And what does that mean? Well, he was part architect of the process that's used largely intact to this very day by FDA to evaluate new therapies for this particular condition. And I'm pleased to tell you, IMC-1, our combination of famciclovir and celecoxib, a dual mechanism antiviral therapy, has been granted the very first ever fast track review designation by FDA as a drug candidate to treat patients with this particular condition. So go alone is a viable option, partnership is a viable option, and we don't really need to raise capital until we get through our data reveal sometime in September of this year.
For those that don't know, can you just talk, what is the fast track designation and what does that mean?
So fast track review designation is basically consistent with FDA's views of significant unmet medical need in the space. I think everybody, patients, providers, payers, would argue there's great need to do a better job of treating these patients. And then the second criteria is the novelty of the approach. There's never been a combination antiviral therapy that's shown such great data, such great promise. And by having been granted that fast track review designation, it entitles us to more regular dialogue with FDA and is a first step in potentially accelerated review down the line, presuming the data continue to be positive, as we've seen in phase 2A.
Yeah, so, pretty, not giving out like candy is the point that I was trying to make with that. So
It's a rare designation for sure. It does not. It is not given out like candy by any stretch of the imagination.
So okay, so I guess when we're talking about Virios Therapeutics, we're really talking about like this is a multi-year story, probably major catalysts coming in the next 12 to 24 months, right? Is that a fair timeline here?
Yeah, so I think on the timeline, as we talked about, we have a major catalyst coming up this September. So
Okay.
8 months, maybe a little less from today, we will have the opening the kimono, if you will, on our phase 2B data. This is a very significant value inflection point for the company. The other milestone on the timeline I should mention is sometime this quarter, we hope to announce a second program, could be with IMC1, as I mentioned earlier, or with IMC2, in a second indication to broaden the pipeline. And in particular, we're looking at two things. One is irritable bowel syndrome, which is a disease that affects something north of 200 million people worldwide. Again, another chronic disease not well treated to date. The other thing we're particularly intrigued with is fatigue that's associated with long COVID. I think the world is finally waking up today to the fact that COVID's a bad thing. I think we've known that for some time. But the extended version of this, which affects somewhere between 1 in 5, and more recent data suggests 1 in 2 patients who get the acute phase of COVID-19, the disease, if you will, will go on with their symptoms for 6, 9, 12, in some cases up to a year and a half, are still suffering from the breathing issues, the fatigue, the brain fog, the pain that's associated with the acute form of this disease. Right. As we start to understand this disease, the next evolution in the understanding is, okay, well, what can we do to help these patients, millions of patients who are still suffering from long COVID? And we believe one of the leading theses for why long COVID exists is stacking of viruses. Specifically, Spencer, what we think is happening is you or I or people across the globe are infected with herpes 1, Epstein-Barr, etc. And our immune system, by and large, does a decent job of controlling the virus. It keeps it in a dormant state. We believe the activation of these viruses is what leads to fibromyalgia, IBS, fatigue, etc. What we also believe, and I think there's many in the scientific community who believe this, and now we're testing this thesis, is when you stack COVID-19 on top of these other viruses, which impact the majority of adults, you further challenge the immune system. And it is well known that both COVID-19 and herpes simplex 1, a target of our therapy, both impede the immune system's ability to fight infection. So when you add another virus on, you further stress out the immune system, further reduce B cells, T cells, immune system cells designed to fight infections, ability to do just that. And as a consequence, you're potentially getting breakthrough of some of these other symptoms. And we hope to do a small targeted proof of concept study sometime to start this year to assess IMC1 or IMC2 as a viable treatment for these patients who are suffering from long COVID, which, as you can imagine, is a very significant commercial opportunity as well.
Yeah, that sort of gets to a question that I meant to get to earlier, and then I kind of got distracted. But like, as far as the use cases here, let's go back to that. We talked about fibromyalgia, long COVID, but how do you know? Well, you don't know, I guess is the answer. But like, how do you investigate new use cases? What other use cases are potentially out there?
So we know that for fibromyalgia, for example, just to quantify our near-term opportunity, there's somewhere between 2 and 8% of the population. If I take an estimate on the lower end of the range, our primary research would suggest there's about 10 million people with fibromyalgia. Only about a third are diagnosed, and worse yet, only about 20% are treated. So right now in the U.S., there's almost a little over 3.5 million patients who are diagnosed with fibromyalgia. So the first use case is actually to establish the value of IMC1 in the existing marketplace. And much like we did with Pfizer and Viagra, once you establish the drug in the existing marketplace, you then have the financial wherewithal to begin the education process to docs, to consumers, to accelerate their diagnosis and grow that market to its full potential, and hopefully, as a consequence, enjoy a better business return on the actual first asset. The other opportunities for IMC1 or IMC2 are irritable bowel syndrome. That's a disease that's estimated to be 2 to 3 times larger than fibromyalgia, just to put that in context. So if you think there's 160 million people with fibromyalgia, there's probably close to 300 million plus with IBS. So there's another very significant chronic disease. Fatigue-related disorders are kind of all over the map. I think we all understand what chronic fatigue syndrome is, and we've heard of it. Epstein-Barr has now become part of the lexicon. And that's a disease that we can't really quantify. But what I would say, if you just look at long COVID, and let's estimate that half of patients with COVID go on to develop long COVID. Right? That's the latest estimates coming out of the Penn State analysis. If you do the math on that, and you think about the millions of patients who've had COVID and half of those have long COVID, roughly one half of them have fatigue as their dominant symptom, brain fog, fatigue, low energy. And so that is a market that, frankly, could dwarf both fibromyalgia and IBS as a potential opportunity for this particular mechanism. So there are truly, literally hundreds of millions of patients that could benefit if this thesis holds up. If the mechanistic data, the clinical data, and other data we've harvested to date that show promise continue to unfurl in that same manner, there's a huge opportunity for this particular pipeline.
Again, we're talking to Greg Duncan. He's the chairman and CEO of Virios Therapeutics, ticker on the screen there, VIRI, joining us today on Benzinga All Access. And just to recap with some of the things we talked about, Greg has indicated that the company is well funded through, I think you said Q2 of next year.
Mm-hmm.
We've got a catalyst coming November. Catalyst coming, the following year as they progress through their trial. Of these candidates that again are treating fibromyalgia among other potential diseases such as IBS and long COVID. What else do people need to know, Greg, about the pipeline, about the diseases, and just about what you're working on?
Yeah, I think our biggest challenge, frankly, is that because the founder was really innovative in the way he approached developing antiviral therapy for these particular disorders, the company was really not well known. And I joined the company probably about 2.5 years ago as a director, and then was hired as a full-time CEO in April of 2019. And I brought in a team, a really crackerjack team, if you will. Of course, I'm biased in that regard, having brought them into the company. But as I mentioned before, it's a team that has extensive drug development, commercialization experience. And between myself and the board of directors, we've developed and launched 2 of the 3 drugs in the space. So know this space quite well. As an investor, you want to know that the team sees the positives and negatives, can navigate the challenges that are inherent in any business. And I think this team has proven it can do that. We are searching for a large solution for a very large cohort of patients. We are fully funded, as you mentioned. We have positive phase 2A data, which builds on the positive mechanistic biopsy data we executed many years ago. And we've done this before, so large market opportunity, thesis supported by data, team that's done it before, and funded. So our biggest challenge, frankly, Spencer, is just getting the word out, having converted from a private entity to a public entity just December of last year.
Greg, we will be keeping tabs. Good luck on the trials. Hope they go well. We will know more, as you said, in 8 months or so. And we'll see how things go. Greg Duncan is the chairman and CEO of Virios Therapeutics. Greg, thank you so much for joining us today on Benzinga All Access.
Thank you, Spencer. Appreciate the time to share the vision of Virios Therapeutics.
All right. Thanks a lot, Greg. All right. Hey, before I bring on our next guest, I feel like we need to let's just stretch a little bit. Let's just do some arm circles and do a little bit of that. Let's touch our toes. I feel like we need to, let's go. I'm talking to myself as much as anyone else here, but I just feel like we need to, I'm sitting in this chair, having these conversations. I'm very into it, but we need to move. Let's all stretch ourselves a little bit. All right. I've been sitting in this chair for 2 hours now. Just need to get the blood going. All right. Let's bring on our next guest here. This next company had a thesis, and the thesis was your data is out there. Well, you know that. We all know our data is out there. What are you going to do about it? Wouldn't it be cool if there was a way to A, have some control, and B, potentially monetize your own data that is out in the ether? So let's bring on Neil Sweeney, who's the founder and CEO of Reklaim. They're dealing with that right now. Neil, welcome to All Access.
I feel there should be like a drum roll when you let people into
Okay, that's feedback. Hey, producer AT, going forward, we need drum rolls for every guest. Thank you for the feedback. Neil,
the PowerPoint machine gun open or some
nice
transition to kind of
nice
pick it up.
But before I start asking you questions, I've got this video. I think it's queued up. Yeah, I've got this video. So I'll play it in the background here as we're talking right now. But what was my tease of the company correct?
Yeah. I think the comment about you having a data profile, I think everybody already knows.
Right.
When we started this business, it was really based on kind of the gap really in the market is that, there's 300 million plus people in the US, there's 7 billion people on the planet. Every single person over the age of 16 has a data profile. That data profile is powering $1 trillion annual data market. Every company in the world ingests data to inform their business.
Yep.
Big companies like Google, Facebook, and others are using your data. But, the gap in the market is that your data is in the market, but the only person that doesn't have access to it is you. So, I think what we don't believe is that we believe that your data is yours and that you should have optionality around it. At minimum, you should know what data is out there. You should know who has it. You should be able to action off it. And, I think there's parallels here. You have a credit score. You have an ability to check your credit score, do you not? You have an ability to influence that credit score. Companies use that credit score to decision on whether or not to lend to you. There is no such thing as a consumer data credit score. So, you have a Credit Karma or an Equifax or a TransUnion.
Mm-hmm.
I think as it relates to Reklaim, we are kind of the Credit Karma of consumer data. That's the way we position it. Come to Reklaim and create an account and you'll be able to see all the data that's in the market on you and then option off of it. So, I think, your introduction is sound. It's not as simple as just kind of getting all your data back, but that's really been what we've been focusing on here.
All right, so let's start with the obvious question then. If I am to not trust anyone with my data, why should I trust you?
Well, first of all, I think there's sort of two parts to that is that you don't trust anybody with your data, but what are you doing about that right now? The answer is not a lot, because every time you open a device, a computer, etc., you're incessantly leaking data into the market. So, I think the reason that you should trust us is that we're actually creating the tools to allow you to actually take back control and give you optionality of what's rightfully yours. Nobody else in the world is doing that.
Mm.
If you look at Reklaim, just where we are today, the statistic is what it is. 87% of people in North America, if they come to Reklaim and put in an email address or a phone number, can find data on themselves that other companies have. So we're the only.
Such as what?
Email address, phone number, mailing address, number of kids you drive, number of kids you have, car you drive, so on and so forth. There's all this information that's floating around in the market. So just that in alone, just providing you with that transparency and access is something that a lot of companies could potentially do, but they don't. And, I think the way we've always looked at it is that we've also started to introduce increasingly more privacy tools. So inside of the Reklaim application, there's a VPN. And that seems kind of intuitive, but a VPN eliminates certain types of data from leaking from your device. So if you think about it in versions, in version 1 of Reklaim, we reclaim the data that's in the market, allow you to put it under a profile and Reklaim. And then in version 2, we're actually creating tools to prevent net new data from floating in the market. The byproduct of this is your digital footprint is shrinking, external, and you have more control and optionality around your data. And I would say that the one thing about that that's important is that you'll hear lots of companies talking about you should sell your data or you should get paid for your data. That's true, because the average consumer profile is worth approximately $6,000 per year. But when we started this business, we started on that premise that your data equals money, therefore you should get paid. But I think what we learned over time was that the bigger gap in the market is nobody has access to the data. First, you can provide access, then you can provide the option of compensation should you choose to actually want to be compensated for your data. But the one thing about that is that you need to acknowledge that not everybody wants to sell data. So what do you do for people that don't want to sell data? Those people typically want to protect data. So the optionality is access creates options. Options are compensation or privacy, or some hybrid of the two. That's kind of the formula that we've basically been building over the last couple of years.
So what exactly did Reklaim build here? Is it like a marketplace? It's an app, obviously, but it's a marketplace or what?
Yeah, I would say it's a portal.
Okay.
I think it's not an app. I mean, an app is a component of it. I mean, you can get it on the web. You can obviously use an application, but the best way to think about Reklaim is, it's not a social network. It looks a lot like a banking application or a credit reporting application,
Okay.
where you're kind of toggling into it to check a transaction, to update data, so on and so forth. But the way we position it is that Reklaim is a portal or the front door to your data. And yeah, for sure, on the compensation side, it's a marketplace. Companies like Microsoft, Hasbro, Starbucks, others, those are companies that are coming in and buying data directly from consumers. In that regard, it's a marketplace. On the privacy side, you could argue it's a marketplace too, because you as a consumer are buying privacy tools to apply to how you protect your data.
Well, so then let's go into that. So as a consumer, how am I interacting with Reklaim? What am I doing?
So the starting point is you go to reclaimyours.com or you download the application. You're presented when you come into Reklaim, you're first asked to add the equivalent of an email address or a phone number. What you do with that is we query against 30,000 different partners that we have. These are security firms, data companies, publishers, etc. They show you, they return back to you all the data that's currently in the market. That's referred to as a third-party profile.
Got it.
It's that third-party profile struggles with compliance, but you can then take that data, put it underneath a Reklaim count. Congratulations, you now for the first time ever have got a repository of your own data. The second part after that is then you can make a decision. Would you like to enable certain components of that data in order to be actually sold? In which case you're compensated by the buyer of that data. We provide a transaction record of every single brand that's actually buying your data. We provide you with a weekly paycheck that gets automatically deposited into your account depending upon what you're sharing. You can redeem that paycheck into fiat or cash or crypto. You can do that as well. But if you don't want to actually sell data, then you can go down the privacy tier, in which case you can sign up for our SaaS-based privacy tier, which includes password breach detection, data breach detection. Whenever those two things happen, you're presented not only with the notification, but the actual data and or passwords that have been breached. You can then take that, put it underneath your account. We also provide a Reklaim VPN, which eliminates a lot of the data from your device leaking into the market. And we provide a universal opt-out that we send to data brokers and others to tell them that unless they have a one-by-one relationship with you, they need to remove you from their databases. So that's how we've structured the business.
Got it. And so that's how as a user you interact with the business, but then you also like interact with brands, companies as well, right?
Yeah. So
Yeah.
that's, I would say it's B2C on the front end and B2B on the back end. And B2C is the reason that we created that is when we looked at the market. And if you think about companies like the Credit Karmas or even the Robinhoods of the world, these are direct to consumer companies that have built seamless UXs or user experiences to try to take, I would say kind of a legacy or a complicated model and try to refine it. So if you look at a Robinhood, they're trying to democratize trading by creating this very seamless interface and trying to take share away from kind of legacy players. When we looked at the market, we just thought that it was strange that there was no direct-to-consumer brand that was synonymous with data, knowing that every consumer has data. So like the size of the market is massive. So just how do you sort of create education, knowledge, understanding in a user interface for those individuals? And that's the B2C part. The B2B part is really satisfying the bigger challenges in the market. We typically sell to brands and agencies. So think like a Unilever or an Omnicom Media Group, so on and so forth. These are brands that actually buy data to inform their advertising. The misconception in the market is people buy advertising. Nobody buys advertising. They buy data, and it manifests in the form of the advertisement that you see online or on TV. So we would be selling data to those brands. We would sell it to platforms. So think like a Nielsen, who has a market research firm. They need data to run theirs. They would buy data from Reklaim. And then the third vertical is platforms. The best way to think about the platforms is these are distribution hubs like Costco and Walmart. The Reklaim data sits in those distribution hubs to allow people to actually, buy those. So the B2B side of the equation is, why would you buy data from Reklaim versus buying it from somebody else? Simplistically, it has higher fidelity, is more compliant, has tons of scale, and is ubiquitous distribution. And that runs contrary to what's going on in the market right now, where Apple is restricting the amount of data coming from a device. So if you're a company depending upon Apple data, it's a problem. And your viewers will see this in earnings updates, where you'll hear CEOs talk about our earnings were impacted by privacy changes in Apple. I'm like,
let's see, Twitter said that, Snapchat said that, Pinterest said that, Facebook said that.
And that's the canary in the coal mine that nobody's paying attention to. I mean, clearly I'm biased, but I believe that what's happening in data is way bigger than the EV transition. It's way bigger than the retail transition. What's happening in the market is, first of all, privacy legislation around the world is forcing companies that are using data to get explicit consumer consent. Again, that seems intuitive, but there isn't any consent in the market today, which is going to make for, as an example, the 6,000 data brokers that reside in California alone who sell your data. Those guys are going broke. And so all that share and market share is going to float into the market. And on top of that, what's happened, especially last year, is the big technology players like Apple and Google primarily have vended in and sort of picked up the privacy baton. Apple, everybody now associates Apple with privacy. What Apple's saying is, you should buy our hardware because we're not going to leak data. They can say that because they don't have an advertising business. Google, on the other hand, has an advertising business that has been supplying the entire kind of market with data. They're deprecating the cookie, which is the oxygen of the internet, and basically becoming an island, just like Facebook as well. So the consequence of this is that if you have a dependency on these companies for data, you've got to vend in and find a new supplier, and that's where we think Reklaim is going to pick up all the market share.
So let's go to a question from the chat here. I guess this is the $1 million question: is how do you make money? What's the business here?
Yeah, so I mean, on the compensation side, it's simple. We work on a 50-50 rev share. We work on a 50-50 rev share with the individual buyer. So simplistically, Procter & Gamble comes in, spends $10,000 buying data from consumers. $5,000 gets distributed back to the consumers for the use of that data. $5,000 comes to us, right? So that's how we do that. On the privacy side, that's a SaaS-based subscription model. So in the most basic sense, it's a $10 a month subscription or a $100 annual subscription. That's a 65+% margin business. So I think the takeaway on this, for the individual that's asking this question is, our organic revenue on the compensation side is growing very, very quickly. We've now introduced a complementary revenue line in this sort of privacy tier. And simplistically, as a consumer, we don't care which one you do. We don't care if you want to come in and sell your data, and we don't care if you want to come in and protect your data. We benefit in either case. Our job is to provide you access and then those options to allow you to decide what you want to do. And I would say you typically have three personas: the person that wants to sell data, the person that wants to be all in on privacy, and then you have this sort of pragmatist in the middle who kind of wants a bit of both. And we cater to those three personas by continuing to provide them with additional.
Which of those three personas makes up the majority of your customer base? Is it the data seller, the data protector, or the hybrid?
Well, I'd say, the data seller for sure, because that's what we've been working on initially. The privacy tier is literally brand new. So ask me at Christmas which one's going to be bigger.
Yeah.
But the market research will tell you that it's kind of evenly split. half the population wants to, sell data and half the population doesn't. So if you kind of think about those three personas, if you took it a degree further, you kind of have 1/3 in each bucket, which is an important validation because, again, for your users, the question is like, people intuitively understand this notion of, hey, my data is worth money, I'm not getting paid, therefore I should get paid. That's a kind of a very primal reaction that most consumers get.
Yeah.
And they get very focused on how much money can I make, right? And so, I think the important part is that if you're building a product, and you'll hear other companies talking about you should get paid for your data, that's a very limited market in the sense that you're only catering to kind of a certain percentage of types of individual users. We learned that over the last few years, where we realized that, yes, that's an important consumer, but it's not the only consumer. And our mission is, we aspire to give every consumer on the planet access to their data. That's our mission. And if we do that, we think it's a monster. What you choose to do with that data, as I mentioned earlier, is kind of up to you. Sell it, protect it, some hybrid of the two. C'est la vie.
I'm trying to think what is what's the biggest headwind right now? What, because I can't think of another company. You're sort of operating in this hole in the market here. So I'm not super familiar. I'm trying to map it in my head. What is the biggest headwind that's facing a company like yours right now? Is it the data collection? Is it the customer acquisition? I mean, everyone has a
Well,
problem
no,
with
I
that.
mean, it's definitely not data collection. As I said before, we have over 300 million accounts.
All right.
Like that's not the issue, right? We have more data than we know what to do with. I think, like any small business, the reality is that there's a lot of work to do, and you don't have enough people to do everything. So you have to prioritize one thing over another. I mean, there's good and bad associated to this. You want to do everything, but you can't. So you have to be pretty focused. That's good for product development. So, I mean, I think for us, when we started this business, so just for context, we built this business in my last company. So this was incubated in my last company. We sold that to focus on this one. And that was right around when COVID was starting. And so we sort of put our head down and built all the distribution and built all the scale with the understanding that the public market wants top line. We get that. But you can't drive top line if you don't have distribution and scale. That's often missed on the everyday investor. I'm like, yeah, you just don't roll out of bed and generate 10 million bucks. You got to create distribution and scale. And if you generate distribution and scale, the cap isn't 10 million bucks. The cap is unlimited, right? So we spent the last couple of years really building this distribution and scale, building out the brand. And now we think that, it's about driving revenue and awareness. So, at some point we'd like to get up to a bigger board like the NASDAQ. At some point, we'd like to double the size of our sales team. But we don't think we need more data to literally drive the top off this business from a revenue perspective. We've done a lot of the hard work. So now we just got to focus on really, hammering away on the sales side.
And then can you just speak for a second about the customer acquisition, how you do that, how expensive, is your cost per acquisition? I mean,
yeah. So, I mean, the cost per acquisition for us is actually basically zip. And the reason for that is,
what's that?
Well, I'm getting there.
All right. I'll let you.
So, we're not Instacart, right? So
Yeah.
we're not a social network. So
Yeah.
if you're Instacart, you don't have an Instacart account today, which means you got to download or create an Instacart account to get in it.
Yeah.
If you use that analogy, you already have a Instacart data account. The problem is you just don't have access to it, right? So you already have a profile in the market. The issue isn't kind of creating an account. The issue is getting access to it. So where we changed our model a little bit was that we already have access to all the data. We just need you to be aware that you can come and kind of reclaim the password to get access to it. So the difference for that is it's allowed us to scale really quickly. We don't have this dependency on, doing the traditional cost per acquisition. I'm going to get you to download my app for $2. I'm going to monetize you for $2.10. I'm going to make 10 cents as kind of net profit. That's a great model for Facebook and others, but there's a graveyard full of direct to consumer applications that ran out of money on that. And I think the important thing about, the data market is you having an application with, arbitrarily 5 million kind of people in it is irrelevant. You need to have hundreds of millions of kind of data profiles. That's how the data market works. So, for us, again, I always sort of say to people, I'm like, we're not a social network, and as a consequence, we don't vend into those traditional kind of cost per acquisition models. We're more of kind of a portal, or we're more of like a credit application, which means, anybody who's who's watching this today can literally go to Reklaim Yours, put in, an email address, and then they're off and running. And then we communicate to those users, on a day-to-day basis through a variety of other channels.
All right, Neil Sweeney, founder and CEO of Reklaim. Ticker up on the screen. Neil, a pleasure to chat. Have a great rest of your day, and we'll be in touch.
Okay, thanks so much. Take care.
Alrighty. All right, I'm just looking at the market real fast. It's been a hot second. Man, is there a lot of red out there. See, this is days like today. I'm glad I'm doing this show because it's good to step away. Seriously, if you're trading, I know a lot of you are. If you're trading, sometimes it's just good to step away. If you're not playing both sides of the market, you're getting smacked around, just take a step back. It's okay. It's okay. Let's have some fun. Talking to some founders about their business. We'll learn about different industries. Let's pivot away from data to gaming. Is there a space right now that is hotter M&A than gaming? Name me one. You can't. You had the Activision deal. You had the Zynga deal. Our next guest is the Chief Strategy Officer of Bragg Gaming Group, Yaniv Spielberg. Yaniv, you ready, man? He's ready. Yaniv, welcome to All Access.
Thanks for having me.
How we doing today?
I'm very good, except that the market's being red. But like you said, it's great to step away. And
yeah, forget all that. Forget all that. So, I sort of teed up there for you, but gaming is like on fuego right now. You had two huge deals in the industry this year. We'll get to that in a second. But first, tell us about Bragg and how do you fit in?
So Bragg is a gambling company, a B2B gambling company, rather than the traditional gaming like, the Activations and the Xenia ones. We're a B2B, vertically integrated gambling technology and content company, mostly focused on the iGaming space, so online casinos.
Right.
We also have sport betting vertical and an iLottery vertical. We provide the technology and the content for gambling operators.
And you're in, what markets are you in? You're in the U.S.?
We're in Europe and in the U.S.
Okay.
The biggest gambling markets in the world.
That's it. And just which of those markets? You're fully integrated, obviously, in the U.S. where it's legal everywhere right now. So you're
so it's a little bit different. So Europe is a bit more advanced in terms of online gambling than the U.S. because they legalized online gambling before the U.S. And so we're more European countries than states in the U.S. I think for the viewers that follow gambling and gambling legislation, in 2018, the Supreme Court of the United States repealed the law called PASPA, which paved the way for legalized sport betting and iGaming in the U.S. on a state-to-state level. And so since then, the state started. Yeah.
So the reason I threw you into like the general gaming bucket is because you guys are mobile, right? That's the idea. You're mobile first.
Online, mobile first. Yes.
Right. So mobile is like ridiculously hot right now. So what name us some of your properties and where they're popular right now?
Yeah, so we operate in the European market with some of the biggest names, the Entains of the world, the Leo Vegas, and others. We provide them content and gambling technology. And then, of course, in the US, through our two recent acquisitions, a gaming studio called Wild Street Games, which is distributed throughout the US, well, mostly in New Jersey now, and Spin Games, which has integrations into the biggest names that everyone of the viewers would know, DraftKings, FanDuel, BetMGM, RSI.
Yeah.
Distribute our content in all the states where it's legal.
So again, I want to go back to the key detail you said before, which is B2B, right? This is the key here. We're not talking about a company that like develops games and sends them out into the wild, right? You guys are the technology behind. So how does it work? If I'm from DraftKings and I'm building a new, I don't know, because they have games within their app. If I'm building a new game, I go to Bragg and I say, Bragg, I need you to build this game for me.
Yeah, so essentially the way it works is we will build a bunch of games through our in-house studios. We have various studios around the world. We have one in Las Vegas, in Slovenia, in Reno, and we will create content based on what we think is where the market is going in terms of online gambling. So slot games, table games, Keno games. We'll get them certified in the states where DraftKings presumably operates. And then DraftKings, when they want to show new content to their audience, they will essentially look around and see what's the best content out there. They'll go through different channels to test what the best content is, and they'll stumble upon the Bragg content, which we will integrate into their platform, and then they will sell it on their platform to their customers. So when you go, and I'll give you an example so it makes sense. One of our titles is called Dragon Power, which is distributed in New Jersey. It's always been consistently top 10 games, slot games in New Jersey since it went live in May of 2020. And so all the big operators in New Jersey would offer Dragon Power to their users in New Jersey. And so when you go on the DraftKings or Rush Street Interactive or FanDuel website in New Jersey and you want to go to their casino, you'll see the Dragon Power game as part of the offering.
The reason I like this kind of a model is because Bragg you're getting paid kind of regardless, right? And also you don't have to go out and do the customer acquisition. That is the problem. That, I mean, no offense to anyone out there, but like all these gaming providers, these whether it's frankly any kind of game, it's all about customer acquisition, and they're spending wazoos of money. That's not even a word. Just to acquire, they're giving promos, and I've got 4 apps on my phone. I don't even know how many Bragg games I have within those apps. Probably a lot. That's probably the point, right? Is you're shielded from all those marketing costs.
That's exactly it. And this is the beauty in being in B2B,
right?
Providing it on a rev share model. So the B2C operators, all the names you just mentioned, will go out and spend hundreds of millions of dollars in customer acquisition, which ultimately will grow our target audience, the total addressable market for companies like us, including companies like the B2Cs.
Right.
And because we work on a rev share basis, as long as they keep bringing in new revenue through these customer acquisition channels, we are the beneficiaries of it with an actual bottom line. So our EBITDA is positive and been positive for many quarters because we don't have the associated customer acquisition costs that the B2Cs will have to spend to get the market share.
And not everyone can say they have positive EBITDA. Not everyone in this business, at least. So I guess though, in thinking about the other side of the coin here, challenges would be there's not a huge universe of customers out there for you, right?
Not necessarily. I mean, look, ultimately, legislation is actually, the paradigm is shifting towards legalization.
Right.
You see more and more states legalizing online gambling, more and more countries legalizing online gambling. And we're at that forefront of getting our licenses, certification, and integrations into new countries, new operators. So our total addressable market has grown or continues to grow about 6-fold. And we anticipate that to double in the next few years as well. So our market becomes huge as long as more and more states and more countries continue to legalize online gambling, and that's really where the market is going.
Again, around with Yaniv Spielberg, the Chief Strategy Officer of Bragg Gaming. So, who's the onus on to develop or for the ideation of the game? Is it you, or is it the customer, or is it both of you?
It's us, and
okay.
So we recently acquired a company called Wild Street Games, and it's run by a gentleman by the name of Doug Fallon. He has over 20 years of experience of game development. He became our director of content. So he's the guy who comes up with the ideas, the art, and the games. Obviously, tons of successful titles came from his brilliant mind. And so now as a director of content, he kind of oversees all the different studios. I mean, for those who follow our company, we actually released our first game for our new studio, Atomic Slot Lab, yesterday. And it remains to be seen how it does, but so far we've got very good feedback from the customers that it's live on their sites.
What, aside from mass consumer adoption, what makes a good game?
It's funny, we have this conversation all the time, really. And
I bet you do.
And Doug will tell you, I've been in gaming for 25 years, and I was asking the same question for 24 years.
Yeah.
It's hard to say. Look, I'll make an analogy I think that everyone will understand. You can take the best director, the best producer, and the best Hollywood actors with a really good script and it might be a bust, and you can take, B-level actors, B-level script, and it would be hugely adopted because of whatever, social media, some discussion on this and that. It's very similar in content. You can take a brilliant mind like Doug, the best designers, the best mathematicians, the best delivery, and it will be a bust, or it could be good. However, and this is where it becomes important, it is more likely than not that when you have someone like Doug heading your studios who has a lot of experience, like if you have a really good director, that the games will be better than worse. And so this is why we focus on that.
How long does it take to develop a game? How expensive is it?
It depends. It ranges between 2 to, I would say, 6 months, and anywhere between $50,000 to $400,000 or $500,000. Land-based games take a little bit longer to develop because the math is more complex and it becomes a little bit more problematic. What we have, which is actually very good in terms of the strategy, is we actually have a lot of land-based games that we're recrafting for online. So they already resonate with the users because either they have seen it in a casino or they've seen it on, anywhere. And now when you see it online, it kind of gives you that assurance that the game is good. And so we are using this hybrid model of taking some of the land-based stuff and recrafting it for online.
We haven't talked about Latin America yet. No, we talked. You're in Europe, you're in the US, but what about Latin?
We have some operations in Latin America, and we're growing the operations. As I said, there is a paradigm shift all around the world, globally, Europe, US, and Latin America, towards legalization.
Yeah.
I think that the pandemic, with the lockdowns and closures of businesses, plus the need for tax money, pushed a lot of the governments to be a little bit more rapid in their adoption of online in general, especially online gambling. And so you see a good and pretty quick paradigm shift in terms of legalization. It's something that we follow very closely, and we continue to get licenses in these jurisdictions.
And how many games, just to be clear, how many games have you actually developed and launched, sold?
Yeah, so look, we offer really two types. We have the aggregator model, where we aggregate third-party content providers. We have thousands of games through other studios. In terms of our own exclusive and proprietary games, we've launched over 250. These are games that we've developed. They sit on our remote gaming server. We certify them, we host them, and then of course we sell them to the operators.
So when you're selling a game to an operator, what is that? Are we talking like a 5-year deal, a 6-month deal? What are you're probably going to say, well, it varies, but tell us about the variance.
So look, the short answer is yes, it varies. The long answer is it depends on how successful the game is. Yeah. Again, going back to my Dragon Power example, Dragon Power was launched in May of 2020. It's still been performing exceptionally well, and we're almost 2 years in. Some of the games have a little bit of a slower tail, and then they just kind of drop from the radar, and so you don't really generate money for them. But as long as a game is successful, operators will continue to buy it for many years. Obviously not our game, but I'll just give an example. Think about like a Wheel of Fortune slot game that has been in circulation for 20 years, right? Some of these things continue on for many, many years. It really has to do with the success of the game rather than the contract itself.
Right. Okay. So upfront, you will set an arbitrary. Is it like you'll set an arbitrary term and then reassess every time, or
it doesn't necessarily, because it's on a rev share basis. It's no risk for us and the operator. So as long as the game performs well, we're making money. They're making money. They have the incentive to keep it on. We have the incentive to continue delivering it.
And then it's not as if. So are these exclusive agreements where you're selling, hey, DraftKings, this game is yours?
Rarely. Okay. Rarely we do. There has to be really great buying power and some incentive to us for do it, because part of our model is to go as wide as we can. This is why we are B2B. And so we have distribution in Europe. We have distribution in North America. Our incentive is to go as wide and as deep as possible, because ultimately you want as many operators to have the content. That's how we'll generate money on a rev share basis.
Would there ever be a scenario in which you'd go B2C or no?
We know what we do and we know how to do it. Look, we've been generating revenues and EBITDA for many quarters now. We do it really well. We know what we do well. We're sticking to what we do best. We're going to continue to grow our presence in terms of distribution. We're going to continue to grow our presence in terms of new jurisdictions. But the B2C route is not our forte, so we're going to leave it to the good guys.
And then just as far as the acquisition front, I mean, you guys, can you speak about like the pipeline there of games and what that looks like?
Yeah. So in terms of acquisition, we've done 2 acquisitions, 6 and 7 months ago. Ultimately, for now, we have all the vertical integration that we need in terms of online gambling. So we have European distribution and licensing. We have North American distribution and licensing. And we have a few content studios that are headed by Doug Fallon, who's the gentleman that we've acquired this business and remains with the business. In terms of moving forward, and I think we talked about it many times in our press releases, in our interviews, content is king. So if we were to do additional acquisition, it would be on the content side, acquiring smaller content studios to bring under our umbrella, because the more content you have, the more specialized, localized content you have, the better your distribution, and the better, of course, the margin, because you actually own the content and you don't have to share the revenues with a third party.
Let me think here. I asked everyone the same question, which is the 2 questions I always ask is next catalyst and any secular, tailwinds we've discussed. Obviously, there's mass legalization, but what about secular headwinds facing the industry right now?
So I'll start with the headwinds, and I think headwinds and tailwinds are the same. It's legalization. Most of the time, and especially recently in recent times, it's a paradigm shifting towards legalization. But we've hit certain jurisdictions where actually it went the other way and resulted in us having to kind of readjust our market position in that specific market. So legislation is, of course, something very important. And legislation is not just legalization, taxation and other things. If the state decides that they need more money, well, what's easier than just increase the gambling tax, right? So it becomes, it's a double-edged sword. It's good for us, but it could also be negative for us. Good for us so far because it's moving towards legalization, but it could also be challenging for us. In terms of catalysts, it goes back to the legalization. It's about licenses in the jurisdictions that are becoming legal. And so we're currently in our final stages of getting our licenses in New Jersey, Pennsylvania, Michigan, Ontario in Canada, British Columbia. As more and more states open up to online gambling, companies like us have to get our B2B supplier license for the industry. It takes a little bit of time, but it becomes second nature as you keep doing it more and more. And so catalysts for us will be licenses, because ultimately it opens up more markets for us that we weren't able to operate in.
Awesome. Any questions for Yaniv? Speak now or forever hold your peace in the chat. Yaniv Spielberg is the Chief Strategy Officer. We were talking to Bragg Gaming Group. I think I've exhausted all my questions, Yaniv, honestly. So this was a fantastic conversation. Again, oftentimes on this show, we prefer to bring on not prefer, but we like to bring on customers in emerging industries. We talked to, a DeFi company before. Gaming is obviously emerging in the sense that there is a massive changing of the guard and a massive wave of legalization happening all over the world. I guess the only other question that comes to mind is, would you consider expanding to other markets? I mean, would you consider going to South America, to actually Asia is the big one there. So, I mean, would you consider that?
So of course we follow the legislation. The more countries that open up, the more the opportunity for us to get bigger, sell more platforms, sell more content, and of course increase our revenues.
Got it. All right. Yaniv Spielberg, Bragg Gaming. He's our CSO, Chief Strategy Officer. Yaniv, a pleasure to chat with you today. Have a great rest of your day.
Thanks for having me.
All right. I feel like we need just another stretch. Let's stretch a little bit. It's 11:20. I saw the market is doing what it's doing. I saw people in chat talking Novavax. They just got to deal with Israel. So Novavax up 10% today. But by and large, we are still mostly red. Though we've recovered. We're making a play here. We're making a play. Oh, we got some tunes. Do I hear some music in the background? I like that. Thanks, producer Aaron. I'm seeing some green, more green than I was a half hour ago. All right. We'll talk about this market on Benzinga Live, our next show. Let's bring on our next guest here. Let's go back to the pharma space for a minute, and let's talk to Lantern Pharma. Let's talk to the CEO and president, Pana Sharma. Going to bring him on right now. Mr. Sharma, how are we doing today?
Hey, good morning. How are you, Spencer?
Doing fantastic. It's Friday.
That's great.
It's Friday. I'm hyped. Market's doing weird things, but that's okay. We're not here to talk about that. We're here to talk about you and Lantern. So, to start with the question, tell us about it. Tell us what you're working on and why you're working on it.
Well, at Lantern, we're trying to transform oncology drug development. There's so much data out there about how cancers work or don't work, how they evolve. We use all that data to both rescue drugs that didn't quite cross the finish line and relaunch them in the right setting. And we use that data to develop totally new drugs. When we went public in June of 2020, we had 3 drug programs. Today we have 8. And so that means more opportunities for investors, but it most importantly means more patients that we can treat. In the last year, we've received 3 orphan drug designations. So part of our strategy is to go after very specific types of tumors where we've de-risked the fact that we're going to be able to make an impact on that tumor or on that patient population. And we use a big data and machine learning approach to basically transform the cost. What takes a traditional drug development cycle, say 18 months, can take us 3 months. What takes them tens of millions of dollars may take us less than $1 million. And so we think that's ultimately the real way to bring down the cost of drugs in the future, is you have to smash the process of making it. You can't just expect some czar to say arbitrarily drugs should cost less. You have to change how you make them, and that's what data has done to every single industry. And so we're in a handful of companies that are using AI and machine learning to cut that process and timeline in half or by 70%. And we've repeatedly done it since we've gone public. And so now we have 8 drug programs in process.
I'll ask you about that in a second. The orphan drug designation. Explain that real fast.
Sure. Orphan drugs designation is a brilliant idea. Both the EMA, European Medicine Agency, and the FDA have used that because early on in the pharma world, a lot of diseases were not explored and remained untreated because the market was too small. So the FDA generated a route that you could go after these, what they call orphan populations. And now there's even ultra orphan. So where there's 200,000 or less people affected by the disease, and ultra orphan even lower than that. And they give you extra commercial rights. So extra 7 years of commercial exclusivity to develop your market. They forego lots of fees because it takes millions of dollars just in regulatory fees to file for an NDA, an IND, a PDUFA, and they give you extra help in bringing your drug to market. Additionally, orphan drugs, and we also have pediatric rare disease designation, allows you to fast track. It allows you to bring the drug to market potentially faster if the data from your trials is as expected. And so that for our investors, it saves time. It lowers the cost of our cost of operating, and it gives us extra commercial exclusivity. So it's very important. Yep. And part of the orphan drugs and pediatric designation is that you have a team looking over your data. So for it to get granted, you have to have some compelling data for them to give that.
All right, now let's go to the pipeline. 8 programs going right now. That's a lot.
That is a lot. Yeah, it's and we're able to do that so quickly since the last 18 months because of our AI. Our AI today is about 13 billion data points. I think you probably have a slide, right, to show if you want to.
This guy? Yeah, that's the one.
Yeah, that's our pipeline today. So our most advanced program is in metastatic prostate cancer. We've had some exceptional results so far for the first third of patients. We've improved median overall survival significantly. It's about 12 and a half months. Whereas typically in that line of patient, it's typically 4th, 5th line of treatment. It's about 6 months. We now are launching a trial, and this is an important event for us this year, probably this quarter, in non-small cell lung cancer in never smokers. So never smokers have a very different type of lung cancer. It molecularly has different characteristics, different mutations, and doesn't react very well, doesn't actually respond very well to existing therapies, especially immunotherapy. So our drug LP300, when combined with chemo, historically has actually doubled median overall survival. This drug LP300 actually failed back 7-8 years ago because they tried it in all lung cancer, not never smokers. But when you look back at the data, these never smokers responded very well in 2 very different trials. And so when we teased out, well, why is that happening? We're able to uncover now why that is. They modify certain proteins that are overexpressed in never smokers that get non-small cell lung cancer. And all this is, we're able to do all this because there's so much data out there now, so much knowledge about cancer biology. And it's published and it's available, and there's large data sets. And we also generate our own data. And so all this data gives us better idea of how to target which types of cancers, which subtypes, what the drivers are, and then what drugs can be combined together.
I feel like we skipped over a pretty key point just about the AI. So I'm gonna go there.
Yeah,
There.
that's great. That's great.
Yeah. Okay, so you've mentioned you've got this AI platform, but
Yeah.
go into detail about that. What exactly does
Absolutely.
that mean?
So when we went public, we had about 250 to 275 million data points. Today we have 13 billion. We'll probably grow this platform to over 25 billion this year. And I think it's really the largest oncology drug development platform globally now. And we have some ideas actually to bring it over to 100 billion, but we'll get to 25 first. And what we use this is, it's a way for us to uncover and do experimentation in silico and uncover what biomarkers or genomics are creating response. And so we leverage now nearly 100 different algorithms to answer fundamental questions about why a molecule is working or not working, or what molecules can be combined together. And that allows us to go very quickly to very specific hypotheses into the lab. And so when we uncovered one of our drugs was working because of a mechanism, then we used the computer to understand, okay, what other cancers can we exploit that mechanism in? And we generated a short list of really interesting candidates. We went to the lab, we validated them. All that data then goes back into the engine. So it's really self-serving, because the more we generate, the more lab work we do, the more that feeds into our radar platform. And it's scalable, where this all lives in the cloud. We're at, like I said, we're well over 13 billion now. I think we'll end the year closer to 25 billion. And the algorithms are becoming more and more powerful. So on top of this huge data lake that we have, the data lake is all curated, it's indexed, it's meta tagged.
Right.
On top of the data lake, we have about 100 algorithms now that sit there and understand, what are the different opportunities and problems that we're trying to explore. These algorithms are a little bit alive now, so they wake up when they have data that they can go attack, and they compete with one another to see which algorithm is best. And so this allows our data science and AI engineers to focus more on real biology problems and not just on managing the algorithms. So the tools and techniques in AI have just gotten extraordinarily powerful over the last few years, and we're using those to basically generate cancer drugs faster.
Let's bridge the gap there. So how exactly do you use the AI to actually develop drugs?
Sure. Let's go to there's another slide I have that could be really interesting in the slide deck.
Was it this one?
We can go to the portfolio slide.
Okay, let me scroll. This one.
Yeah. So LP184, we're using this drug in various indications. And if you can look on the slide, it says pancreatic cancer, glioblastoma, ATRT, which is also brain cancer, and then also bladder cancer. And so when we uncovered that 184 was working well in certain cancers, we looked at what was the driver, what do those cancers have in common that allowed it to respond really well at the nanomolar level. There's a slide I have later in the deck, if you go to that, because this shows how machine learning was used for this indication. Going forward.
Hold on.
Right back.
Nope, there we go. Okay.
Back one?
Back one, sorry. There we go.
There we go. Okay. So one of the things that we found is that if you look on the far, I guess it's everyone's far left, the radar insight. Radar took all this data from across all the cell lines that we had and all the experiments, and it showed that the response seemed to be in line with a very specific gene transcript called PTGR1. Now, we knew that PTGR1 was involved in the process, but we didn't know how explicitly. This could have taken a year or year and a half to unfold. We did this in a matter of months. Once we knew that PTGR1 was supposedly the driver for activity, we said, well, let's really test this. Is it really the driver, or is there some incidental thing that we're seeing? We took this machine learning derived signature with PTGR1. We went to the lab, we edited out PTGR1, so we suppressed it entirely using CRISPR. And we said, okay, well, what should happen? And if you look at the top lines on your right, those cells didn't respond when PTGR1 was edited out. In the cells that had overexpressed PTGR1, they died when given our drug at around 100 to 200 nanomolar. So this validated that this kind of discovery was actually even taken to another step, because we said, okay, well, what is this driving? And this PTGR1 is reminiscent of a lot of instability in cancer cells. And so we were able to exploit that, look at what other instability mechanisms can we use this. And this allowed us to go from one indication for 184 to now 4 or 5 indications. And we did that in less than a year. I mean, this normally in the drug development process could have taken years, because it's a lot of hit or miss in the lab. What cells are working, not working? Why are they working? Here we have very, very specific hypotheses generated, and we have networks that compete and say, okay, what new information can we find every time we deliver the data back into Radar? And so this is why our pace of development is faster, and it's de-risked, because we have very specific ideas on why these things are going to work. And sometimes, in the great case of our most recent indication, we got it in ATRT. It affects about 60 to 70 patients a year in the US. There's about 600 patients living with ATRT. There's no known therapy. And our drug seems to work so far really, really well in this ultra rare brain cancer. And it may have been a brain cancer that a lot of companies don't even look at, because they don't know the underlying mechanism. And we were not looking at ATRT. It's not like we woke up and said, hey, we really want to go after that brain cancer. Our AI platform, once we saw that worked in GBM, we said, let's enrich it for every single brain cancer out there. And then what bubbled up to the top as being one of the most responsive, in silico, of course, was ATRT. And when we looked at, okay, well, why is this? There was a genetic overlap in ATRT due to a gene called SMARCB1. And I don't want to get lost in the technical minutia, but basically there was a correlation that we were able to make. And the correlation could have been made by really smart cancer biologists, but it would have taken a long time. And the machine was able to do it in a matter of not even 2 months.
Damn, that's Gabe. It seemed, I'm not like, obviously I'm not a scientist or a doctor, but it seems potentially game changing.
Yeah, because typically drug development, Spencer's done, people who understand the biology of certain disease like pancreatic or ATRT or some liver cancer, you have all these specialists. And what they do is they take whatever drugs possible and they slam them against the cancer that they know best. Right. Or then the other side, you have chemists, medicinal chemists say, hey, I have a really interesting molecule or a series of molecules and they're related, and they push them against all different cancers or diseases. So it's like this very large scale, like shotgun expeditions that take millions of dollars, years and years. We're narrowing that down and saying, we're using data to say, how will a compound or class of compounds or a drug hit the right cancer? Because we've also modeled all these cancers. We've gathered all the data. And we continue to gather data. It gets smarter and smarter. And so we're able to, this is really how precision drugs should be generated. And it's no accident that companies like Moderna and BioNTech were first out, because they used computation to generate the vaccine.
That was my question, is like, why isn't everyone doing this? But I guess some people already are.
Yeah, and RNA is RNA vaccines are a lot simpler than the biology of cancer, but there are a handful of companies with, all of which have been hit in this biotech downturn. But I think there's a whole new wave of medicine where you're going to have much more productivity and much more precise drugs. There are literally almost 1,000 different types of cancer, maybe even more. And do you know how many drugs are approved right now? Molecularly targeted drugs? Less than 90. So
that's in total?
In total, yeah. Wow. So you have a lot of chemotherapies and cytotoxic agents and palliative care, but in terms of targeted drugs, less than 90 drugs. And so, yeah, we're not in an era of precision oncology yet, but we will be. But we have to make drugs more rapidly, and we have to make them less expensive. And the only way to do that is to use data and machine learning to take all the knowledge we have out there and do this more rapidly and with less risk. And that's what we're doing.
Yeah. So you're applying this to the entire pipeline, right? We should add, and then just since you mentioned the biotech downturn, can you just speak a little bit about like whether you're like your funding, whether you're fully funded, and how far out you are, and
Yeah, I mean,
next catalyst
we
and all
have
that stuff?
we had 73.8 million on our balance sheet as of the last reported quarter.
Wow.
We're burning about 4 million a quarter. Our historic burn rate was about 2.4. We increased it as we started some trials and closed manufacturing. So we have capital for several years. And in that process, we'll be able to license out or partner out our drugs to bigger biotech or bigger pharma. So any one of our drugs can be sold for hundreds of millions or billions if, as we mature them. So I think our goal is to find, discover, develop, and then partner or license out. And we think we can do that better and faster than anyone else.
And I want to go back to this slide just to reiterate. So you've got 2 drugs in the phase 2 trial right now, and then everything else is either preclinical or R&D at this point. So we're very early stage in those.
Well, no, actually, we'll be launching the pancreatic and glioblastoma into the clinic this year.
Okay.
This is a big year for us. So not only will the 2 existing phase 2s mature and be in a position to potentially partner out license, but pancreatic glioblastoma and maybe ATRT will go into the clinic into patients this year.
Did you already say the timeline on when we'll get the phase 2 results on those on the prostate?
Probably very late this year, and lung cancer probably next year. That's a 90 patient trial. 60 patients will be treated with our drug, and 30 will be the control arm. And that'll be just a U.S. only, probably about 15 to 20 sites. But that never smoker population is about 20% of new non-small cell lung cancer cases. We think globally that's about a $2.5 to $2.7 billion market for a therapy. So if you think about cancer deals, they're typically done around 4 or 5x peak sales. After phase 2, there's a 50% discount to maybe a phase 3 success. So that's still looking at potentially $1 to $2 billion sale, once we're successful to a larger company. So like I said, any one of our drugs as they mature can be sold for hundreds of millions. We also have a pediatric voucher that we received recently. We can sell that for 130 million or more. That's what an average voucher sells for. So there's a lot of ways for us to continue to monetize our assets, and more importantly, generate new drugs faster and cheaper, because ultimately the most success is going to be when we are able to affect, hundreds or thousands of patients. And we think we have the ability to do that over and over. So it's not just, hey, you're betting on 1 or 2 drugs. We think we can do this repeatedly because our platform is getting smarter, our algorithms are getting sharper. And so we can go from 8 programs to 10 or 12 or 14. So we think this could be an evolution for the next several years.
What kind of IP protection do you have?
We've got 90 patents so far. We have patents on the core drug compound itself, the chemistry, on the manufacturing of the drugs, the methods of use, like which cancers are we pointing them to. We have IP that we've filed on our platform. We have IP on the signatures to discover which cancer patients can benefit the most. So yeah, we have a multi-layered kind of patent strategy, everything from core composition of matter to manufacturing of the matter to manufacturing of intermediates to which cancers do we point at to the platform. So again, about 90 so far. We filed an additional 14, 15 patents last year. So yeah, we have a fairly aggressive patent strategy.
Panos Sharma is the CEO and the president of Lantern Pharma. Mr. Sharma, a pleasure to chat with you as always.
Spencer, thanks.
We'll keep tabs on the phase 2 trials and the upcoming phase 1 trials, and very exciting stuff. Thanks a lot for coming on All Access today.
Thank you.
All right, everyone. We have made it to the final guest appearance of this week's show. Our last appearance until next week. So without further ado, let me bring on our last guest of the day as we head into this middle of the day time where people go eat lunch, volume gets a little bit lighter on the markets, and we're liable to see some things change here. So let's bring on, we'll get to the markets on Benzinga Live which is going to start at noon today. I'll be there for that. Don't worry. But let's bring on our last guest speaker of today of All Access. We're talking to NetSol Technologies, the chairman and CEO, Najib Gari. Excuse me. I'm going to bring him on right now. Najib, how are we doing today?
Good morning, Spencer. I'm doing awesome. Thank you for having me.
You're awesome. I'm awesome. Thank you. It's awesome to have you. Awesome to have you. Tell us about NetSol. We're talking like a technology platform for financial services, right?
Yes. So we are a mission critical IT solution provider, which is focused on the leasing and finance industries worldwide. We've been doing that for the last 20 years. It's a mature company. When we say end-to-end solution, all the auto captive finance companies like Daimler Financial Services or BMW Financial Services or even GMAX sort of names, they depend on our technology to run their multi-billion-dollar portfolio on our systems worldwide. It's an amazing system. It's a niche business for us. Not many providers out there. There's selected companies like NetSol and a few others in the different markets. We operate in all three regions, Asia Pacific, Europe, and North America. We're headquartered in California, where I'm based right now, and about 1,500 solid technology professionals worldwide. We're also moving to the new direction, innovation, pivoted from license to SaaS, and I'll give you some color in a few minutes.
Well, can you give me some color right now?
So I think, Spencer, all these years, we've generated over $1 billion in license business, compounded revenue from the license sales, because the license sales have been a high ticket item. Like the biggest deal we had was 5 years ago with Daimler Financial Services for almost $110 million to support 12 markets in Asia Pacific with the next generation technology that we had introduced in 2015. So now we have generated a lot of revenue, and we also realize that the market is going toward a SaaS model, cloud, and we pivoted quite effectively 2 years ago so that we are able to get into the mid-tier market. Dealing with the license market is a very expensive module and bigger Fortune 500 companies. But when you go to the mid-tier market, like in the US, in the retail sector, we're dealing with the, for example, a mini auto cars dealership. They're using our retail platform, and that is a quick solution for a dealer, for someone who wants to buy online Mini Cooper. They can do it, and it's a easy term, monthly term, and this is how we're building a SaaS model.
So the auto finance industry, that's your biggest industry, right? That's where most of your business comes.
Absolutely, 80% actually.
Wow. Okay, but you also sell to asset managers as well.
Well, I think we deal with the CIO, CFOs of the world.
Okay.
All these companies who are running multi-billion-dollar portfolios, they need our system. And we deal with Stuttgart, we deal with Munich and BMW, we deal with a lot of companies in China. And they're all the C-level executives who really depend on our system day in, day out.
And just to spell it out, they depend on NetSol for what?
The technology, the IP. What we do is we develop solutions, customized in most cases. In some cases, now that we're going to SaaS model, which is ready to go, so implemented right away in the dealership location. But the bigger picture that we've been doing for the last 20 plus years, Spencer, is the dealing with the auto captive finance company. These are the bread and butter for the company for so many years. Like I said, we generated over $1 billion in sale, and the customer like Daimler, BMW, Honda, Volvo, Toyota, all these big names, European, Asian customers, some American, are dependent on our business to the point that 30 million consumers are transacting their loans through our system one way or the other. Because we are interfacing our system in the captive finance headquarters, like in Singapore or Beijing or London, the headquarters of these big companies, but they are interfacing with the dealers and the company who are actually using their loans capability to sell their product through our system.
So, like, what is a typical like deal structure for you? I mean, like, what are the terms of these deals with Daimler, Honda, et cetera, BMW? Like,
yes,
we're talking 2, 3, 4 year contracts or what?
Yes. For example, I'll use two cases. One is the Daimler and the second is BMW. Daimler is our customer for 20 plus years from the beginning of this company. And then we had a next generation technology, which was introduced in 2015. In 2016, we signed a 10-year contract for close to $120 million, which includes three components. The first one is the license fees, which is worth about $55 million license to go into the 12 markets of China, Japan, New Zealand, pretty much 12 markets of Asia Pacific, which we have a dominant position. So the first part is the license revenue. The second part is the implementation phase. That generates $30-40 million in implementing the new system in each location, several modules in 12 countries. That is the most beautiful thing, because when you are rolling out this system, you have to be physically present to implement the system with our team and their IT side. And the third part is the perpetual maintenance income. Every year we generate sizable revenue from, for example, Daimler, because we're supporting them to make sure they're up and running 24/7 in all the markets they operate. So that is the three way of generating revenue. It's a minimum 5-year relationship. And in every case, we've been able to renew the relationship. 15-20 years is a common, I think, time period with our key customers. BMW was signed up 3 years ago, 2018 in China market for $40 million, and we implementing this solution in all their locations in China, because the sales are growing in China. So is Daimler. So all these big companies who are our customer depend on a long-term basis, because this is how you continue to support your transaction on a daily basis.
You talked about the transition from the traditional licensing model to the SaaS model. I'm just go more into that. Like, how difficult is that exactly? Because you, on the one hand, you can't disenfranchise your old customers with the new model. You have to sort of scratch both backs at the same time, I would imagine.
Absolutely not. They're a customer for long term. Every single customer who has a licensed transaction, we are servicing them, and they're generating more revenue because there's more add-on, more features that as their business grows, they need to keep customizing and ask for more help from the company. So our relationship is stronger. We call it business as usual, our core business. Our core business will continue to grow at a 10+% rate on the top line. What I'm talking about, additional business we're trying to generate through SaaS, as I said, in the mid-tier market, for example, motorcycle leasing companies, Yamaha Motors or Motor Lease in California, we signed them up a few months ago, and that market, we didn't have it if we didn't have the SaaS structure. So these companies cannot afford to pay tens of millions of dollars compared to Daimler or BMW or Toyota of the world. But the smaller companies, the middle ticket item, they need a monthly payment plan, and that they're getting same results. So I think we have covered both ways, bigger market through license transaction and a mid-tier through SaaS. And that pivot is important, because not only that, we pivoted on the pricing structure, pricing model, but we also pivoted on the technology, on cloud and mobility. Because as you know, everything is, one of the benefits we've seen from pandemic, if one of the best that came out is everything's gone on e-commerce, online. So that will help us pivot very quickly into the retail sector to direct our connection with the dealers in the US.
So I wanted to ask you about that. Like working with these online dealers like a Carvana, for example. I mean, like how is the shit? Like, how does that impact your business?
Well, the first time, I mean, my revenue from the US is about less than 10%, 90% from Asia Pacific and Europe. Now we implemented, we rolled out in a mini dealership which is owned by the BMW Group, as you know. We rolled out a 13 dealership in California, pretty much maximized, and we have another 90 more to go across the US. So it is growing incrementally, because dealers can see the app in very quickly and then implement it within like 1 hour, and it's up and running. Anybody can go. If you're living in, let's say, LA or Orange County, you have a dealership, you don't need to go to dealership physically. You'll find all the features, all the functionalities to get the perfect transaction, whether through credit approval, all the term, payment plan, and so forth. And then once you've signed on, you made the transaction, the next day, the mini car will show up on your door, and this is it. So this is the new area for us. from the traditional license business, which is a long cycle. We have a very sizable pipeline for the license deal and now for the SaaS transaction. So I think we're growing slowly, but in the strategic market in Canada and in North America. So it's really very helpful to the company for the long-term footprint in the US America, where the market is huge. Imagine how many thousands of dealerships we have in the US. There's no limit. You can go to every single brand, Toyota, BMW, Daimler, they all are customers in different markets. So we getting a jump start, a head start to go to these dealers because of our relationship. For example, BMW is a big customer in China, or Daimler in Asia Pacific. We're getting help from these companies, from these OEMs, to go to the retail because they need this application to move the inventory faster than just before when they're just doing the transaction with the companies directly on the license basis.
What are some of the challenges that you're facing right now?
Well, I think definitely in pandemic we were affected because travel ability was impossible for the last 2 years. Now it is opening up all the markets we operate in, China and Europe and USA. It's now slowly but surely they're happening. So we lost some time and our revenue dropped in the last 2 years. So now we're returning to the old revenue base. We had about average 55 million each last 2 years. Before that, we had $68 million revenue in 2019 before COVID. Now we're coming back on track. So we overcome the challenge by working effectively remotely from home offices. All my programmers working in main place in Lahore, Pakistan, and other countries, they're able to effectively implement the system and continue to interact with the customer on hourly, minutely basis. But now our sales team is able to function, ability to go travel in certain markets like Europe, for example, UK, and in Australia. China is a bit tough. There's a 3 weeks quarantine requirement for incoming business people. But these are the challenges, I think. But the reality is that opportunity is quite unlimited. The market is still very wide for the retail system I just talked to you about. We are a de facto leader in the Chinese market. We have the most multinational customer in China and the local auto manufacturer in China. So we enjoy a pretty good position. I think we are in a good position to really take off. This is a fiscal year 2022, which is we just finished December quarter. We shall report sometime at the beginning of next month. And I think we gave the guidance to overcome these challenges. We want to make sure the market understand that we have finally resumed the guidance because we feel comfortable about it, the top line guidance and some other metrics.
Speaking of the guidance, the forward-looking statements, how long, I don't know if you've said this yet in prior statements, but how long do you expect before or until the license revenues get back to pre-COVID levels?
Well, we're looking pretty good. We have almost pipeline over $200 million in 3 different markets, particularly in China. Europe is looking pretty good for us, and North America has the best pipeline than ever in the history. The reason is we have methodically worked with the new customers and existing customers in the global market. We've been able to meet them through the conferences and virtual meeting. I think there's a good sign that there could be some potential new license deal as well as new SaaS structure deal.
Like what? Like what kind of new deals?
AutoCap, I cannot give you the name because they're not public yet. Auto Captive Finance Company, major US companies and European companies doing business in the US. And I can talk to you about Daimler, which is a global customer. They are an opportunity for us in the US, or BMW is also an opportunity because they're already customer in China. So we have pretty good interaction in connection with the customers, no matter where they are, headquartered in Munich or Germany or other parts of Europe or China. They open opportunity for us in the North America. And the mini dealership is one example of that BMW network we have in China. And so I think in the US market is growing. Auto sector is still on fire in all the big markets, China especially, and in the US. I think we are in a good shape to really get into some new customers, sizable customer, and some existing customer in different market. But then now we can get them in the US market.
Awesome. Again, just to recap here, we're talking to Najib Ghauri, the chairman and CEO of NetSol Technologies, a technology platform for mainly the auto finance space, but I guess more financial services because they do have other buckets. And just to clarify, everyone, Benzinga Live should have started already. And the stream, when it ends, it'll redirect to Benzinga Live if that's why you're here. 5 more minutes. So Najib, anything I'm trying to think, like, we talked about the impact of COVID and you know how that's impacted the business, and is there anything we haven't yet discussed as far as like what makes the business go?
Look, very nice. Spencer, we are now a fintech company with mobility and cloud solution and uh, the retail system we have in the US. But it allows us to really open up the opportunities, not just limited to license, but to the mobility SaaS model in the US, particularly North America. North America, I mean Canada, and of course the US. So I feel very strong about where we're heading after we're such a mature company. We've been around for many years.
How
Still a
how,
small,
how long you been around for?
22 years as a
22.
Nasdaq company, yes.
Okay.
And I mean, you've gone through ups and downs, and we have seen a lot of, I think, challenges, and we overcame a lot of challenges. A lot of time, company that had a $1 billion valuation in 2000 went down after the dot-com crash.
Yeah.
We recovered, and the good thing is, for last 10 years, this company has not raised one penny in the market. We are just doing all organic because we have a cash cow, solid cash coming in the company, renewals, maintenance income, SaaS, new revenue. I think we got everything that a perfect technology company, a global fintech, operation in 9 countries, almost 1,500 solid professional servicing the company, and almost 300 customers, supporting $300 billion of transaction on a yearly basis with our product. That shows the capacity and the scale we have to support the largest names in the auto sector. So I'm very comfortable with the future where we're heading. I think we have a good position in the US, we're strong in China, and we're also getting some strong momentum in some of the European market, including UK.
Awesome. All right. Again, NetSol Technologies is the company, and their chairman and CEO Najib Ghauri. Najib, a pleasure to chat with you today. Thanks for coming on All Access, and have a good rest of your day.
Thank you so much. Enjoy your weekend.
All right.
Have a good day.
All right. We got a hot because Benzinga Live is starting or already started. I'm not sure. Before I go, though, I want to repeat what I said off the top of this show. A few things. First off, everyone that was on All Access today did pay Benzinga to be here. It's how we monetize our channel, but they had no idea what I was going to ask them. So you had your time to ask as well. We will be doing this show every single Friday going forward in this time slot between Pre-Market Prep and Benzinga Live. Second thing is all of these shows that we do every week are sponsored by Ticker, TIICKER, Ticker with 2 I's, TIICKER/Benzinga. They will give you perks for owning shares of a company. The link is on the screen. It's in the description. And here's some more info about that.
What is Ticker? That's right, Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
All right, click on that link in the description that's on the screen. Well, you can't click on the link on the screen, but type it in, and that will bring you to a landing page. Open an account, confirm your email address, and link your brokerage, and check the box that says you're from Benzinga, and Ticker will send you a $20 Amazon gift card just for doing that. So thanks to them. Thanks also to Redchip, Investor Relations, for helping us organize this show today. Without them, we could not have done this week's show. They were instrumental in arranging these interviews, these conversations, and giving us access to these companies. So thank you again to Redchip. Thanks to all of the guests today, all the companies, all the speakers for coming on. We recognize that CEOs lead very busy lives, and we appreciate them taking a few minutes to hang out with us. We'll be doing more of this show. Again, the whole point is to give access to the C-suite and talk about the story, because there's more to life than just the heat map of the day. That being said, let's go to the heat map of the day. Let's go to the charts. Let's go to the markets. I'm going to end this show. We'll go over to Benzinga Live, jam-packed show. I'll meet you guys over there. I'm sure producer AB is doing his thing right now. So drop me a like if you'd be so kind. And I'm going to wrap this up. See you guys over on our very next show. I'm going to end this show with a commercial. Let's end it with a commercial for our swag store. Check out our swag store.